Good morning.
Good morning. How you doing?
Good. How about yourself?
I am fantastic. Fantastic. How was your preparation review last night?
It was okay. I read a little bit before I went to sleep, and I did some more this morning because I've been up early. I don't know why. I just couldn't sleep. I was up like every hour on the hour. I went to bed early too, so that might be why. I went to bed like about 8:30 before dark. And then I woke up like every hour on the hour from 3 o'clock until this morning. So at 5, I just stayed up and got up at 6 and took my shower.
Awesome. So we may have a couple of people join us. I have
Okay.
a couple more because they are scheduled also to take the exam.
Okay,
Um,
that's fine. No problem.
yes,
To me, it
yes.
seems like the more the merrier. And I actually remembered a lot of this stuff. It's like what I'm gonna do today is everything that I highlighted yesterday and whatever I'm gonna highlight today, I got another book like this.
Uh-huh.
Write it all in it because I know when I write stuff down, I remember it more. So I'm gonna just like rewrite all my notes that I'm gonna study. And I printed out because I thought I had printed out everything that you had sent me. I didn't print out that it's a workbook. I didn't print
Yeah.
the 122 page workbook.
Yeah, I don't know if you wanted to print that.
I didn't at first, but I was like, I might need it. So I did it this morning. Um, and I put it in a whole nother binder. I'm gonna go through that later this afternoon and maybe a little bit tomorrow. Yeah.
Or something else. That's all I'm gonna say.
Yeah.
Something else. That's awesome.
I like printed stuff because it to me it doesn't bother my eyes as much as reading off of the computer. So I'll print something in a minute.
Okay.
I got a thing with HP um
On
smart
the
where they send me ink and stuff. Yeah, I've been waiting for my ink to run out because I still have black ink. They won't send me none until it's completely out, and I think it's almost there. So it's not bad for like $6. The only thing I worry about sometimes is going over the pages, which I probably did, but it's okay.
don't they roll the pages over though? Do they
I
roll?
have some that was already rolled over from a couple of months ago. Yep, so I don't went through all of those too.
All right.
But I think my new one started on the 12th, so I should be fine.
Okay, great. Well, so what we plan to do this morning
Hmm.
is life and the life only portion.
Okay.
So when we do the life,
Mm.
we will probably cover some of the um underwriting, a little bit of the underwriting, again, kind of go over the contract law just a little bit.
Okay.
All right. Because I
I
know
know that some stuff is like it's double.
that's
'Cause
right.
when I was highlighting, I looked at some of the life stuff. I was like, when I was reading over it to see which section was which, I was like, okay, this is life, but it says the same thing that we went over yesterday. And I'm like, okay, so some of the stuff do double. So I had to put like another little tab in my book and put health to separate the health from the life because it makes it easier that way. And I was like, okay, we went over this yesterday, so I like
All
repetitive because it makes me remember it better. So yeah. Yeah.
right. We got Sherry back.
Good morning, Sherry.
Good morning. I'm sorry, I was just coming from walking, so
Oh, you're fine.
but
Ooh,
I'm in my car. I'm coming.
other time. Um, let me see if let's see, I invited, I don't even remember, but let me double check. See if they can make it still.
How you doing, Felicia?
I'm good, and you?
Good. How you feeling?
Good, 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 good.
That's
Good.
good. Hey, that's a great sign when you're feeling good
Mm-hmm.
about this exam.
Yep.
That's always fantastic. It's I don't want to say it's not a hard exam. So I just want to, you know, it's a lot in the exam.
Yeah. And like what Sheridan was saying yesterday, how like they'll ask you the same question in a different form. When I first took the test, I saw that a lot, and I'm like, well, didn't I just answer this? And then I don't know if I answered it right or wrong, because it was in a different form, but I do vaguely remember like seeing a couple of questions, and it'll be like not the next question, but like 4 or 5 questions down the
Mhm.
line. You'd be like,
Yep.
didn't you just answer this? So it's like a lot of repetitive stuff that it's like it seemed like if you get it wrong, they'll ask it to you again. And that's what I was
Mhm.
wondering. Did I get it wrong? That's why why it's being asked again in a different way. So I'm just gonna remember to look out for that.
But that's why I was saying if you know the basic
Yeah.
stuff, the basis of it all, then it helps you to do it,
Mm-hmm.
to get all of them, all 3 or 4 of those questions right, knowing the
Right.
basics.
Yeah. So
Yes. And the same thing holds true as far as where am I going to get the points to.
mm-hmm. Yeah.
So the points are going to remain in types of life policies,
Mm-hmm.
policy provisions, options and riders, and the state.
Yeah.
So if we look at those areas and really just nail them, and
Mm,
you have, a great number of your points in that section because they weigh the most, you're
right.
going to pass. Now, you cannot just go in and not know anything on the other side, right? When
Right.
I say the other side, your taxes, your, what else? Uh,
Just the
your social
basic
security,
terms,
yeah, your just other stuff that they have in there, right? You
like
under
unilateral.
underwriting, you just cannot.
Yeah, you still
And
need to
not
know
knowing.
that it's not as um what word am I looking for?
You're going to
Significant.
get more. You're going
Yeah,
to get more from the other.
right.
All right. So, okay, I got a Zoom user who's coming in this morning.
I'm sorry. This is Pamela Clark.
Hey,
Good morning.
good morning.
I'm sorry. I'm working, so
Okay.
let me change my name here. Always forget that.
All right. Okay. Um, we're gonna kind of get started. And again, I just really want you guys to um put your filing cabinets together. Put everything in your mind. I mean, Sherry, you are just on it. And for you to be on it so early, I think after I taught this class the third or fourth time, then it was in filing cabinets. And as I taught it the 10th and the 11th and the 12th time, then it was like the way that you have it right now, that's the way it finally got into my head exactly like you do. And I'm like, wow, for you to get it that early. Hey, when I took the exam the very first time, I did not pass this thing. It was the only thing I had going for me is that I bought insurance before. And you think that, oh, because you bought some insurance, you're going to have it, But no, what it does was bring up a whole lot of questions about, well, what did I buy? Did I get something good? Did I get something bad? And so
Right.
when I'm talking, I'm telling you all experiences, the things that we suffered with, just not knowing.
Yeah.
And then you go out to try to share to the world how how bad the decisions are that we're making. And we're spending money on some things unnecessarily. I look at the last company that I worked for, they had an HMO plan and a PPO plan. And, I was like, you know what? I'm just going to go with the HMO this time, right?
Mhm.
And it was good. It was a whole lot less expensive for us and our family. All I did was check for one doctor, and really it was for my daughter. And it didn't matter for us because we didn't have any love for anyone, and then once I got out of the baby making stage, I really didn't have any love for an OBGYN.
Mhm.
So it didn't matter who we were going to. And then I started realizing if the primary care physician says, go to this doctor for cardiologist or for orthopedic something, you're going to go there.
Mhm.
It's no big deal. So it's not like you really want to go out of network. You only want to go out of network when you start getting sick,
Mhm.
because that's when, you need to see these other specialists that are all over the country. And, that's when you need the PPO. But in your young ages, please. So I was like, you're just making financial mistakes and just overspending in
Mhm.
some areas. That's
Mhm.
all. So if you would buy a life insurance policy when you're young, how much money you save for the rest of your life, even though you could have paid it off early.
Mhm.
That's all. You could have paid your policy off in 20 years and stopped paying for it. We think $100 is a lot of money until you start going to dinner for two,
Yeah, that's it.
and it's $100.
Right.
It is.
And don't go to dinner expensive, with buying a bottle of wine, you at $200, so,
Mhm.
and we don't blink. We
Mhm.
don't blink at it. We just like, okay.
That's how these young folks are. They go to Burger King, McDonald's every day, 2, 3 times a day. The money they
Recording in
spend on
progress.
that, they can actually take and go buy a couple of packs of meat and cook dinner and save money, but they don't look at it like that because all they want is that real quick fix of something to eat and keep it moving. But
Keep it moving.
if they realize how much money they spend in a week on fast food, they'll stop buying fast food and start cooking.
Yes.
But I know someone may not know how to cook, but hey, they look at YouTube for everything else. Why not learn how to cook
That's right. Why
or
not learn how to cook?
whatever? Yep.
All right. So, Pam, I'm not putting up any slides. We're really gonna talk through this. We're gonna take some notes. Um, I think I just have Sherry. I don't believe Sabrina's gonna be able to join us today. So we are going to just kind of go through I won't say everything. We're going through mostly types of policies, types of life policies, policy provision, options, and riders. We are not going to do the state all the way through, but we are going to look at those 3 or 4 questions that may be at the end, those things that you have to answer on the life side. Okay. Now, Pam, please remember that when you go into your online program that you have, you need to study the state that's inside that online, because that's where your information is specifically for Arkansas. Okay. So I don't want you to forget that. Okay, great. All right. So in this session today, again, we're going to start with one of the basics, okay? So Sherry, when we talk about the basics, we're going back to that contract law. And we ended yesterday with lack, right? Lack. So we got to remember contract law. And what is the contract going to be? What's the contract?
Mhm.
What is the entire contract? Let me ask it that way.
The entire contract is the application and the policy.
That's right. That's right. So when we talk about the contract, we're talking about the policy.
Hmm.
So we're just talking about it at the beginning. In the beginning stages when it's all apart. You haven't made the agreement yet. So the contract, it has elements. And those elements, we use the acronym LAC so we can try to remember. Okay. So what is LAC? What are they? What's the 4 elements?
I know what it is.
Just say either
Mhm.
one of them, any of them. Say that again.
Agreement.
Okay, that's the second one. Yay.
Legal.
Yes.
Yep.
Oh my gosh.
Remember this? Remember money?
I'm trying to remember what I'm trying to remember what it is. I can't remember that part. And the last, oh my God, why can't I? And I just looked at it.
Look at me. Look at me.
The mental is oh, I can't remember those two. Legal agreement.
If they're not mental, they're what? In
Mental competent.
competence.
Okay, and I'm still trying to remember the money.
Value.
I can't remember that one. I know it's going to come to me.
Starts with CON.
I am drawing a blank right now.
Okay.
Is it consumer?
Consideration.
Consumer?
Oh.
No,
Um,
no, it's not consumer. I know that.
is it classification?
No. Oh God. Legal.
Is it competent?
I already said competent.
Mm-hmm.
And
Is it characteristics?
no.
Is it consideration?
Consideration.
Oh, so you do know. Okay.
I just can't remember what the last one was.
Okay, so consideration, competent parties, agreement, and legal. That's going to be a question that's going to be on your exam. It will show up 2-3 times because, again, you're taking the life side, the health side. It's going to be on both sides of that test. So it's going to be there more than once. You got to know what the contract law is, those 4 elements of the contract. That's why it's there. And that's why you all say, oh, I saw a question more than once. And yeah, it's there more than once. Okay. So legal contract is those 4. Now, agreement has an offer and an acceptance. Within the word agreement, there's offer and acceptance. How do I ask that question? Offer and acceptance. Offer and acceptance. So how does the insured make an offer?
The insurer.
The insured, ED, client.
Application.
That's right. And how does the insurer accept? How does the insurer say that they're accepting it?
They
Felicia, who's the insurer?
the insurer would be the insurance company.
That's the insurance company. So how then do they say sure? you gave me an application. What do they do then?
Issue a policy?
That's it.
That's it. Simple.
So
Okay.
just think about it in that way. Think about who is the insurer and who's the insured. I'm the insured, so I'm going to make an application. And then the insurer is the company, so they're going to give me a premium.
Very good. All right. So now let's take a look at, we looked at those. All right. So we have those other three, those characteristics of a contract: adhesion, aleatory, and unilateral. Adhesion, aleatory, and unilateral. Now, I don't have any words to go with these yet, and I'm gonna hope that Sherry's gonna give me those words, man. And how you remember them? You know, we say adhesion, we
You
say
gave it to me.
uno, uno,
I'm gonna
and
tell you, yeah.
aleatory. But I don't have any special wording to go with them. But those are the three that you're going to find on your exam. All right, you got to know the difference. You got to be able to find them and be able to tell which one is which. So which one do you understand and know?
The take it or leave it, which is adhesion,
Oh, very good.
That's it.
and aleatory is
Yeah. Sherry, do you remember?
Yeah. Yeah,
Mhm.
I do. So first before you go to aleatory, go to unilateral. See if that'll help.
unilateral.
What's uni mean?
One
One. So what does that mean? Unilateral.
one-sided.
There you go. Look, you see me? I'm telling you, I was in the test doing all kind of stuff. Just like that. One-sided. Very
And
good.
aleatory is uneven.
It's
Uneven value.
there you go.
That's
Yay.
that's a
Unequal
good definition.
exchange.
Okay.
It's an unequal exchange, and that's probably how they'll have it on the test.
Unequal.
Yes. Unequal exchange.
And you know what that means?
Yes, you're getting something more for less.
There you go. That's how Tanya taught it to me. Those premiums, and then you got that big old benefit, death benefit. Like, what? Wait, you're right.
Yes. So that will probably be an example. Probably be an example.
Okay.
All right. Signatures on an application. Signatures. Whose is required?
Yours and the agent.
I am the agent. You
The
said
agent.
yours.
The agent, the new client. So
Okay.
me and you.
All right. Changes on an application.
You draw a line through it, initial it, or just start a new, well, on the application, yes, or you could just do a new application.
They may ask, what's the best?
A new application.
All right.
I don't think they had that on the test though, that way. Just to know, they what I saw was to draw a line through it.
Okay.
An initial. For some reason, because I looked at, I remember asking myself, well, what about the new application? That
Yeah.
wasn't one of the options.
Okay. Well, I knew from just being in the military that that's how you correct applications or paperwork, is to draw a line and initial.
See, if you were as old as me, you would think that we would do some whiteout.
Yeah.
Whiteout.
Oh, I learned that we couldn't do whiteout because
Right.
of it being a government document.
Yep.
But when I first joined the military, that was how I was like, yeah, we got some white out. It was like, why? Because I made a mistake. Oh, just draw a line through the initial.
And in the banking system, I couldn't draw a line through it.
Right.
I had to redo it.
Yeah.
There was
Right.
no line and initials in the bank. No, ma'am.
And when we used to be in the day of filling out applications, writing them, that's why it was important. Now everything is computerized. So we
Mhm.
don't even write an application anymore. We barely even sign it with our own fingers. And
I
then-
still do. Even
Yeah,
with
that's good.
DocSign, I make sure I turn my phone if I'm on my phone, the long or the wide way, so I could, and I use my finger. I know they give or produce signatures for you, but I don't like none of them.
Mm-mm.
Mhm.
Nope.
All right, so now if an application has a premium, what kind of receipt is it? If you're completing the application and you get the premium, you give them a what kind of receipt? Good morning, Baruch. You can also join in. I know that you're scheduling yours sometime this week too. So let's rock and roll.
What is this? Let's see. Yes.
I didn't get a note. Okay. All right. What kind of receipt? Did they have anything about the receipts on there, Sherry?
They did. You have to know what that is.
I just saw that.
And this type of receipt is also, it means that
We
the
talked about this yesterday.
yeah, the applicant may be covered as early as the date of the application, especially on a life insurance. So you give them, there's only two types of receipts that they even may bring up.
Oh, I just seen it this morning briefly.
So remember what we talked about yesterday when we talked about you expect to get a receipt when you go to purchase something.
Guaranteed.
No,
No.
it's not, because remember they just have the application. They haven't done any of the underwriting. So until the underwriting is done, basically, well,
Ah,
as the agent gives it to you, what does it mean? It's not temporary, but it's something that starts with a C.
very good, Pam.
She wrote it.
Yeah.
It's another C word.
That was gonna trip me up.
Okay, so
I just seen this thing.
it's kind of an optional, because if everything is good, then they are going to start the application on the date that you did it. If they do not, then you'll do it later. So it's based on the C
That's
word.
okay. We're gonna come back to it.
We're gonna
So
come,
go ahead and give her the answer.
huh?
Give her the answer and we'll come back to it.
Conditional. It's a conditional receipt. Now, that word conditional, when they give you the 4 options for LACC and they tell you which one is not, make sure you know it's conditional because consideration competent parties, they got another C word to throw on that line. And normally it's the word conditional. So you need to make sure conditional goes with the receipts, conditional receipt. So they're saying, hey, if everything is all right, under these conditions, this policy will begin today that we're sitting down, or it will not, based on now we're going to say your physical condition. Okay.
Yeah.
All right. So then after you completed your application, it goes into underwriting.
Mm-hmm.
And the underwriting is a risk, R-I-S-K, selection and classification process. That's what underwriters do. And there's going to be 3 options. Well, really, there's only 2 options that come out. No, but I'm gonna go ahead and use the word 3. So when the underwriter looks at the application, he's going to say either it is one of these 3. What is it? Standard is one option.
So I think what I saw in the test, it was around the classification. So what are the 3 classifications that that the underwriter can rate you as? And that's for memory. That's why I said it that way, Tanya.
Yeah.
Just for memory. You could either be, she gave you one, you could be standard, or you could be,
If you're in excellent condition, you're considered what? And if you're in bad condition, you're considered what?
excellent condition, above standard. I don't-
starts with a P.
Perfect.
Nope. There's no perfect person here on earth. Look,
Yeah.
don't make me start praying.
Oh, Pam, you got it right. That is absolutely right.
Preferred.
Oh, now you can read it. Go ahead, Felicia.
I didn't see it the first time.
Preferred. That's right. And if you are a preferred status, what may they do to the premium? What's the options they have now to do to that premium?
Lower it.
That's right. And if you're the other one, what's the last one? So your preferred, your standard, and now your
Remember. Standard.
Not quite standard. What's that word?
Substandard.
There you go.
go ahead, go Pam, you got it. And then what happens to the premium?
Is higher.
That's right. So you got that much. That's great. And that will possibly be there because everything and every question is going to be dealing about, okay, here's this thing. Now, what's it doing to the premium? Here's this thing. Now, tell me a little bit about the money. All right. So when they look at the application for the very first time, they want to identify what we call insurable interest. When must insurable interest exist?
Well, first ask, what is insurable interest?
That's true.
Do you remember what that is? Because that'll help. That'll help with that question.
Issue. I just seen that.
Okay.
My notes are all over the place.
All right. So Pamela, you know what insurable interest is and when must it exist? So look at it this way, Felicia. Felicia,
Yes, ma'am.
okay. Insurable interest. All right.
Mhm.
Um,
I'm gonna take this to
why would you get an insurance policy on someone?
Um, why would I get one on someone?
Mm-hmm.
To one, cover their burial, and 2,
Give me a little more emotion to that.
So Felicia, here it is. So look up because so look up. So you're getting insurance on me
Mhm.
because why? I'm your
Dependent?
no,
No.
because you're taking care of me. I'm your child.
Okay.
So why would you want to get an insurance policy on me?
A more emotional feeling.
And what if I were your child and I had bills?
So the insurance policy would cover the bills after you pass away.
Because who's interested in that?
Me?
Right. So I'm your best interest, right?
Yes.
Right?
Yeah. Hmm.
What answer are you looking for on that, Tanya?
Love.
Yep.
I'm looking for
And financial
and
situation.
financial.
Okay.
Yeah. So because of that, because you love me, and and it's that financial situation.
Right.
So now that you know who I am,
Right.
when then, what was the question, Tanya? I'm sorry.
When must insurable interest exist?
Can you start loving me like 6 months after you get their policy?
No, you should love the person prior to that.
Okay,
I think so.
Yes.
whenever you're doing an application, when must insurable interest exist? Look up.
2 years
No, now.
Right
now.
now.
Okay.
At the time of correct, Pamela, at the time of the application. See, insurable interest on some insurance policies can exist later on. I
Okay.
can't remember what it is for property and casualty, but it's something different. When you're doing a life and health application, it must exist at the time of application. So the first thing your underwriter is going to do is they're going to look at who's the owner and then who's the insured.
Okay.
And they want to know what's the relationship here. So
And I can't go get a policy on Beyonce. I can't go get a policy on her right now. But yeah, just think about it like that. I can't go get a policy on Beyonce just because I think she's great. They're not going to do it because they want to know what's my financial interest there. The insurance company wants to know what's my financial interest and do I love her? Well, I love her as a person just
Right.
because, but I don't know her.
Right. Okay.
And I also explained that when I was talking about you even trying to get a policy on your sibling.
Mm-hmm.
If I try to get a life insurance policy on my sister, they're like, oh, no, you have no financial interest there.
Unless you're taking care of her.
Right. Unless we live in the same house, unless we're taking care of. That's when there's financial interest here. So when you're looking at insurable interest, this is when they're probably going to talk about you can have a policy on yourself. You can have a policy on a family member. You can have a policy on a business partner. And that's what Pam had answered a few minutes ago. So insurable interest must exist at the time of application, and the policy owner must have insurable interest in the life of the insured. Now, Sherry, what I don't remember is whether or not they had anything regarding the application and whether or not it was in two parts, general information, medical information.
It wasn't on my test.
Great. Okay. So we're going to keep going on. And just remember the Fair Credit Reporting Act.
That was on the test.
Yeah, it should be on them probably more than once. Fair Credit Reporting Act. The Medical Information Bureau,
MBI.
Yep. And also, HIPAA possibly.
Yeah.
Now, where most of your questions, scenarios will still probably be around delivering the policy. And if you paid the premium or if you didn't pay the premium. And all I'd say to you is follow the money. Follow the money. If you paid the premium, already,
Mm.
that policy has a start date of when you sat down with the person, as long as everything was good. So when you deliver the policy effective date will be the date of the application. If you didn't take the money, then your policy start date, effective date is when you deliver the policy.
Okay.
That's the simplest way to say it. And you're always going to get a statement of good health. I think that's going to be on there. Statement of good health. All right. We're going to move straight on into types of policies. Types of policies. All right. So I need you to tell me everything that you know about term insurance.
Me?
Yeah. Let's go. You, Pam, Baruch, everything. Everything y'all know. Type it in, write it down, say it out loud. Let's go with term insurance.
Ooh, can I go?
Go ahead, B.
Um, Term insurance is temporary insurance. It doesn't produce cash value, and it's usually a period of time that
Mhm.
they will have the contract for.
Mhm.
Very good, very good. And what about what about the premium on it?
Yeah, that's all I was about to ask.
Can someone tell me about the premium?
It could decrease and increase.
No. Usually a term policy's premium is very good, Pam. Lower. Okay, so the premium on a term policy is going to be a lot lower, and you're going to get a greater amount of coverage. So that's another piece. So you all were absolutely right, B. You're perfect on that. You know, it's term, it's no cash value. It's pure death protection. It's for a specified period of time.
But what if the policy expires? Do you still have coverage, guys?
No.
Thank you.
Have to start
Just a
over.
question.
Very good.
And then sometimes when you start over, depending on, well, of course, because of your age, it's going to be a higher premium than what you was paying before.
All right, very good. So now there are types of term policies. What are those types of term policies? Come on.
Level.
Level.
Yep.
Okay.
Annually renewable and
Okay.
increasing term.
Very good. All right. Now, when? Okay, increase and decrease. Beautiful. So we got to know the difference. And when they're talking about the difference in these policies, we need to understand it is the death benefit that they are saying fluctuates here, or what's the level. The death benefit. What's the death benefit? When I say death benefit.
The death benefit is what is paid out upon the death of the insured.
That's right. It's the
Okay.
death benefit, the amount that's going to be paid out, the amount of your policy, or it may say the face amount. That is a death benefit. I got $100,000 policy. That means that my death benefit is $100,000. Okay. So what I'm saying is that the death benefit is level. The death benefit is level. That means that that is going to be from the beginning to the end of the policy is going to stay the same. When they say it's a decreasing term, the death benefit is going to be at one number and go down to another number. Okay. So we need to make sure that we remember that. Now, a level term refers to the death benefit, which does not change. Now, if you have a level term policy that's $100,000 for 10 years, what does that mean?
That if the
A level term policy for 10 years, what does that mean?
that for 10 years it's gonna stay at 100,000.
And 10 years and 1 day, what do you have?
Nothing.
Nothing. Now, there is something called an annually renewable term. And so what does the annually renewable term mean?
That means that it you could get it after your term, and it will renew every year with the premium going up every year.
Stop it. Yes, ma'am. Yes, ma'am. That's right. Absolutely right. And then we have something called the return of premium, which is also known as an increasing term. The return of premium is also known as the increasing term. Oh, yeah, let me just keep going. Return of premium, increasing term. So the increasing term policy means that what? Return of premium. What does the return of premium policy mean? What is it? What is it? It's exactly what it says it is. So tell me, what does that mean to you? All right. Good morning, Raquel. Hey, Quita. Hey, Keisha. Hey, Pam, Baruch, and Felicia.
Morning.
Good morning. So what we're doing today is that we have Sherry, who just recently took the exam, and she's in here helping us to know what was on the test. That's one. And helping you guys refresh so you can get ready for the exam. So we have about an hour and 25 minutes, maybe more to go, and we're going to be done. So we're going to cover the main two areas. Our main two areas here is going to be types of policies and policy provisions. So we dealt with already the term. Now we're talking about the return of premium. It is a rider that's placed on policies. And because it's called the return of premium, then what does a return of premium mean? That sounds like a great thing. We got a policy that is called a return of premium. What does that mean? Paid if death occurs within a specific, paid if death occurs in a specific time period. Okay. How to help them remember that? Go ahead. Quita, you gonna say something?
Oh, I didn't know if is this open for anybody? I thought the return of premium was when you return all of your premiums. It's exactly what it says, right? Isn't it?
It's
Return
exactly
all
what
these
it says.
premiums. Yeah.
It's exactly what it says.
Okay. I was looking for the hook. I was like, it's a return of all your premiums.
Yes.
Okay.
And that return of premium could come in two places. Number one, it can come at the end of the policy and you still lived. You outlived the policy. So
Outlive the policy.
you can get your return of premium then. And you were right, it can be paid if a person dies. So if they died, then part of that rider says, I'll return all of the premium to you too. So it'll give the death benefit and it'll give the return of premium to the beneficiary. All the premiums that a person has paid in.
Mhm.
We have some key words here: renewable and convertible. Renewable and convertible. You got to know those two words. They're going to come up. And if they don't come up on the test as a question, then they're going to come up within the question. So anytime something is renewable, it doesn't matter what comes in front of the word renewable, behind the word renewable. What is renewable?
You can renew your policy without having to show proof of insurability.
Yay.
Absolutely. And what may happen to that premium?
It's going to go up.
That's right.
Do you know that can transfer?
That's absolutely right. So we got to know renewable. Then what about convertible? Convertible. If something is convertible.
You can change it over or switch it over to something else.
Okay. What happens to the premium?
Goes up.
You can convert it to permanent. That's right. That's good, Pam. What happens to the premium? What'd you say?
It goes up.
The premium can go up. Do I have to have proof of insurability? No, that's right, Pam. No proof of insurability is necessary. There we go. So those are two things, convertible and renewable. The premium's going to go up and no proof of insurability is necessary. Boom. Now let's talk about whole life insurance. What kind of questions were on the test regarding term and whole life, Sherry? Let's get to that so that we can move on to something else. I can't hear you.
I thought I had myself unmuted. So knowing that, what are the whole life, when you think about the three whole life options that Tanya talked about, what are those options? One was whole life. The other was what?
Limited pay life.
Yep, that's the second one. And what's the third one? Anybody?
What did she say?
Limited pay,
That's right.
whole life. And what's the third one, guys?
Is it universal?
No. That's
Just-
not what we look for, right?
No, we're looking
No.
for ordinary.
It's the
Oh,
whole
it's
life.
ordinary.
Regular whole life. It's
So the
how
third one is, so the third one is ordinary. And so Tanya, what they're going to want to know is, so when you think about whole life, limited pay whole life, and ordinary life, whole life, what is whole life? What does that mean? The same way Baruch talked about what term was, what is whole life? What are the components to that? That's, yep, Pam, that's one. The
Oh.
cash value,
has cash value.
it's scheduled to equal the cash value. Absolutely. Something else. Something else?
Living benefits.
No, we're talking about the policy,
Okay.
not necessarily the benefit. Think about the policy. What does the policy bring? What is it about the policy? How does it protect you?
Pay your premium.
How does it protect you?
It covers your entire life.
Okay, say the death benefit. No, but that's true, but no. Yeah, well, it protects you for what?
Your whole life, or to 100 or longer.
Well, let me ask you a question. Is the protection temporary or is it permanent?
Permanent.
That's what they're going to want to know. That was on the test.
Permanent
Is
protection.
it permanent protection to what age
100.
or
Death.
yeah.
Or death? Death?
Yeah. Yes.
I'm like, I hope it's death.
But you want to know, because if it says death and it doesn't say 100, then you want to know that it's either till you get to age 100 or until death.
Okay.
Question about whole life policy. Is that something that you could borrow against or take a loan out on, or no?
Yeah, you can use the cash value in it. Yes.
Yay. Yes, you can borrow against it.
Yeah.
That part was on there. So you want to know what whole life is. Tanya, do you want to delve into what limited pay whole life is?
Was it on the test?
I don't remember it being on the test.
Okay. So just a definition of limited pay is that limited pay policies, you are going to pay it up. I'm trying to look for words. You're going to pay this policy up before you reach age 100. You're going to pay it up in advance, a limited pay policy. So a limited pay whole life policy is designed so that the premiums for coverage will be completely paid up well before age 100. And normally they have a 20 pay or a 65 pay, but they normally come 10 years, 20 years, 30 years, limited pay. Then you also have single premium pay. So that's just dropping one lump sum, single premium pay, single premium whole life. One lump sum. Then they should be trying to get you to understand the difference between universal, variable, joint. What else? So now we're going to dive into the different types and see if Sherry can remember. Maybe Quita can remember a little bit about what did they look for or what those answers were, or the questions regarding universal, adjustable, those death benefit options. Because if not, then we're just going to stick on those words.
So what I do know, I do remember adjustable life being on there. And so when you think about adjustable life, is that something that's fixed or flexible or what?
It's flexible.
It's flexible, right? So on an adjustable life insurance, can it be term or permanent? Which one can it be, term or permanent?
Permanent.
Or it could be, remember, it's adjustable. So because it's flexible, it could be what?
Both
sorry.
term and permanent.
Yes, it could be either or.
It can be
Remember,
term.
all of the adjustments that can be made. Tanya talked a little bit about it be, something that could be converted. Can this one be converted also?
Yeah, you could start with
Yes.
the term and
If you
before
start
you could have it.
Yep,
changed over
that's
to-
right. Remember, adjustable. That word adjustable, which means flexible, which means all of these things can apply. That was definitely on there. And along with that came the rule of 72. Does anybody remember the rule of 72? How do you how would you calculate the rule of 72? And well, what is the rule of 72? Let me say that.
That's when, oh my God, you calculate how long it takes for your
Money.
or your money to double.
Yep. So how long it takes to double. And so I would suggest that you remember how to calculate the rule of 72 because I had to calculate the rule of 72 on my test.
Really?
Yeah, I did. Quita, do you remember doing that?
No, I don't remember doing that.
Yep, I did. I don't know why.
I had the question with the chart. Remember we did the chart where we had to do the term.
Yep,
That
was there.
And you had to select the option, select
Non-forfeit
which option. Yep.
Yep,
You had to
there
select
too.
the option. So I had that question. And
So-
that was right in my face because we did that exact example.
Yeah, so exactly. So I don't know if answering some questions pushes you to a different question. So all I want you to know is how do you calculate the rule of 72? You don't have to know anything else about it. If you know how to calculate it, then when they talk about it, you'll know what to do. So
Okay.
if I had an interest rate of 6%, how would I calculate the rule of 72, which says how many years my life insurance or my life insurance would double? If my interest rate was 6%, how would I calculate it?
You take that and you divide it by the amount of your insurance policy.
Nope. It's not that much because it has nothing to do with the value of my insurance.
It's about the term. It's about how long, right? For the term.
This is about how long will it take for it to double? For my money to double, how long will it take? So how do you, if my interest rate was 6%, how would I calculate it? It's very easy. And that's why I want you to know this is just very easy thing.
Okay, tell us, Sherry, tell us. I'm waiting with bated breath.
For bated breath? Okay. It's 72. Remember, it's the rule of 72.
Okay.
So it's 72 divided by the interest rate.
Yes.
6% or just 6.
Okay.
That means that in that scenario, it would take 12 years to double. But all you need to know is 72 divided by the interest rate. That's it.
Okay.
So if they give you a scenario or if they ask you any questions where the rule of 72 applies, it's 72 divided by the interest rate. And yes, I did have something about the rule of 72 because remember, Tanya, I told you I had to do calculations 2 or 3 times. That's what it was.
Wow.
And again, it just all depends. I really do believe that questions change based on your responses.
Yes, they do. So it's really good to go through and mark what you are going to pass. And if you get something right, then they may change it to something else. If you keep getting it wrong, that's why they may ask you over and over.
Over and over, yeah.
Universal life. Universal life. Minimum premium, target premium. So if the insured skips a premium payment on a universal life policy, the missing premium may be deducted from the cash value. The policy will not lapse. That's one main thing about universal. And universal has a minimum premium and a target premium. and they have 2 death benefits, option A, option B. Were those there?
So
I don't-
universal
Yeah.
life is a term or something?
It's a policy.
Universal life is,
You said no, it wasn't there?
it wasn't on mine.
It was on mine.
Okay.
Yep.
So premium,
Do you remember what the question was, Quita?
I don't, but I knew that it was universal life. I knew that was the answer. It was kind of like around what type of policy is this?
Or
It
what-
described the type of policy, like Tanya just did it, and then you had to select the A, B, C, and D was what type of policy it was.
okay.
all right. So remember there's 2 different types of death benefits in there, an option A, option B, and it'll have minimum premium, target premium. That's going to be universal life. Universal life. Variable. Anytime you saw something variable, that meant that you're going to have 2 licenses. 2 licenses. What kind of license were they?
Security.
Securities and a life insurance license. Yes.
Yeah.
2 licenses. So you had to be dual. 2 licenses, and then you have 2 departments that regulate, and that's FINRA and the Securities Exchange Commission.
So
What else was variable? Anybody else remember? And normally it's going to have the word investment risk. Investment risk. You'll know that that's a universal policy.
A variable policy, yeah.
That's
Yeah, you mean
right,
variable?
variable policy.
Variable
Yes.
policy.
Now, you said these are types of policies, right? But these, okay, I think I'm a little confused. Okay, so we talked about whole life and it said that was a limited pay and ordinary pay, but these aren't whole life policies?
They continue on.
Okay, so these are other whole life policies and on
Absolutely.
top of limited pay and ordinary.
That's right.
Okay, no problem. I'm good.
These are all, if you don't want to use the word whole life, use the word permanent policies.
Gotcha. I'm in there.
Okay.
That's what I was gonna
Because
say.
the difference between, all they want you to know is the difference between what's term and what's temporary and what's permanent. Temporary is just that one term thing that's increasing and decreasing and annually renewable. Whole life, permanent policy is a whole life policy. Then from the whole life section, just the basic one, you have a limited pay and you have single pay. Right? And then permanent policies, as we continue, boom, are also universal policies. Universal means that it's this, and they may throw in index universal.
Mm-hmm. They did. And so if it's index universal, what does that mean, guys? What does it adjust with?
Stock market.
The stock
the
market.
stock market. Right.
Yes.
Yes. All right. Then we are dealing with joint life and survivorship. That should have been there too.
Mhm.
That was there.
It was there.
Yes. Knowing the difference between a joint policy and a survivorship policy. So what's the
I have
difference?
several questions on that. And now that you're saying, like he listening to Sherry, now that you're saying it, I must have gotten one wrong because I had a series. It kind of triggered a series of questions around the husband, wife, scenarios.
Yep.
Like who died first, who would be the beneficiary?
Right.
So is joint talking about 2 different people, and then survivorship is talking about a husband and wife?
Well, so here's the main question on that. The question is, if it's a joint life policy, who does it pay for? Does it pay when both people pass away, die, or does it pay when one person die? Who does it pay for?
Pays for when one person die.
The first one or the second one?
The
second
first
person.
one.
The first one.
The first
On
one.
joint, that's the weird thing about joint. It says it's
That's what I
joint,
got wrong.
but it pays for the first death,
First person.
the first person.
And then survivorship would be two people, right?
Right. So
It's
it
on the,
who does it pay for? Does it pay for the first death or the second death?
The second death.
It pays for the second death.
Okay, so joint pays for the first death
Right.
and survivorship. That's
person.
what I got wrong. Okay, the first person to die. The
Yeah.
survivorship pays at the second person. Both people have to die.
That's
The
correct.
second person has to die.
Yep. So think about
Yeah.
it when people, Tanya gave us an example when we did this, that on a joint life, usually, or maybe I'm sure I got it from Tanya or I got it from doing a test. When somebody has to, like if you and your spouse buy a $500,000 house and your spouse is the one that's really making all the money, and you want to make sure and get a policy so that if he dies, at least I can pay off my house. That's what a basis is for that. And I've seen that in my career. So but it was when you title it joint, that it's confusing. So just know when the first person dies. And survivorship, that is if me and my spouse making $5 million and my spouse dies, that's going to help me pay those estate taxes. Or if both of us die, then the estate taxes will be paid, and then my kids can just walk away with the money. So add something to it when you go back and look at it. Survivorship, that is whoever survives from us, whoever survives, that's what it's going to pay for stuff like that. But it only pays when upon the second death. Got it?
Got it. Thank you.
very good. All right, so, that's most of the policies right there. We've dealt with them. We've dealt with joint, we dealt with survivorship. We've dealt with universal, variable, adjustable, whole life, and term. We did. Now, the last one is annuity. An annuity isn't a policy. I want you all to remember that it has to deal with, what's that magic word about an annuity? What does it
It
produce?
doesn't have to do with life insurance.
It's not a life insurance policy.
Yeah, it's not a life insurance policy. Yeah.
How does it get its money?
You have to pay
Through
into
the little market thing or whatever, like it's not guaranteed, or it's guaranteed, or some stuff is guaranteed, some stuff is not guaranteed.
Tanya, I might be going ahead of you, but
Okay.
so there are 2 periods in an annuity. So what are those periods? What are those times?
Fixed period.
No.
No.
accumulation.
Yes.
Accumulation.
Oh,
And
Accumulation.
when it's accumulation, what are you doing?
You're paying in.
Paying in. Very
Yeah.
good.
paying
What's
in.
the other period?
It's another A.
The annuity period.
It's the annuity period.
That's
Very
right.
good.
It's the pay
And during that time, what are you doing at that point?
You getting the
You're
money.
receiving your fund.
You're getting paid out.
Get paid out. Yeah.
Accumulation period and annuity period. Yep.
Mm.
Accumulation
Good.
and annuitization. And you see how she remembered one is paying in and paying out. That's going to be important. That's going to be important. And it is giving you income. Income. That is the magic word around an annuity. It is giving you income. This is income you can't outlive. Everything ought to be in an annuity. When we learn about annuities, man, you need to have an annuity. Stop fooling around with that 401k. Okay. So the annuity is going to be based on the life expectancy. Right? So they gotta make sure that the person, the annuitant is a person. So when that money is being paid out, it's got to be to a person because they're going to be looking at the life expectancy. The shorter the life expectancy, the higher the benefits are going to be paid. The longer the life expectancy, the lower amount that they're going to pay out. So they may give you an example of two people being the same age, one male, one female. I don't know. But the life expectancy of the female is going to be longer, expected to be longer than the life of a male. So she would receive a lower amount. They do, I don't know if they're going to deal with the premiums, whether or not you have fixed and level, deferred, or immediate. Do you guys remember any of that being there?
I don't remember that being on there, but it's not bad to know it.
Okay, so anything that begins within a year, that's immediate. Anything after a year is deferred. So those payouts, you're going to put this money away for a little while, and then if they can begin to pay it out immediate, that's within a year. If they're going to pay it out later, that's anytime after a year. That's deferred. Anytime after a year is deferred.
Has any of you ever won the lottery?
Oh, no.
Anybody ever won any money on the lottery?
Nah.
So just know this, that lotteries pay out in annuities. So basically, when you hear that someone won $5 million on the lottery, they say they want all their money back, they're getting a single one-time lump sum. That's a single premium lump sum. That's what they're getting. And then sometimes people on these lotteries, they get paid out over time. And those are the ones where they get level premiums. So maybe if that may be just an example of something that might help you remember that, what an annuity is and how it could be paid out, either in single or level premiums. That might have been a little bit too much, but I have to connect stuff together. Sorry.
All right. So on the annuities, again, you have to know the phases. You got to know who the parties are, your beneficiary, the owner, and the annuitant. The types of annuities, you're going to have a fixed annuity. You may have a variable annuity, and you may have index annuities. Then they're going to always deal with the premium, y'all. Always deal with the premium. So the premium can be one lump sum payment. Boom, you're going to pay in one lump sum, or you can have flexible, where you're paying in multiple. And that is going to be created over time. So if you take a young person may put in, $2,000, $3,000. They're going to pay into this over a time so that it builds up. Older people are going to just take one lump sum from something that they have and drop it in. So, and then how is this money going to be paid out? It's going to be paid out in an income. So in types of policies, we need to recognize the difference between term, whole life, right? Term policy, whole life policy, the ones that have the flexibility, right? And then you have your variable, your combination policies. So those are the different types of policies. We got to score high in this section because it is a section that weighs the most. So when you're studying, we want to focus on the types of policies. Now, where do I go? If you guys go to the videos, inside the videos, there were all the pages, right, for the text. But at the end of the text is a chapter recap. And that chapter recap is going to give you the basics that I got to understand, because we're understanding the concept. I'm not memorizing any words. The only words and stuff that I want you to memorize is those state unfair trade practices. State unfair trade practices. Okay? Other than that, it's not about memorizing anything. Our next section is all about policy provision, riders, and options. Now, the policy provision section, again, is a huge area. It's a huge area. So in that area, we got to remember some things. So let's see if we can put it all together. Let me see. And remember, policy provisions, this is the story. So when you come and sit down with your client, you're supposed to be telling them this stuff about their policy. You're holding the policy in hand. You're delivering the policy. You're not talking about what you enroll them in. You're talking about all of these other options that they may have in their policy. So the first one, of course, is the entire contract, and the entire contract is made up of.
You're on mute, Felicia.
It's made up of the application and the policy.
That's right. Then you have the insuring clause. The insuring clause. This is the what? I'm about to say word.
The first page of the policy that has the agent's name, your name, all your information on it.
That's right. We're going to be looking for that word. It's probably going to be part of the agreement, because that's where it's going to define who those people are. The agreement, the insurer and the insured are now bound together. Then they have a free look. What's the definition of a free look?
Refund.
Yes, a full refund. Refund of premium. All right. And then how many days is our free look?
10 days.
There you go. So this is the only period. Did they ask it specifically about once you deliver the policy? Sherry, did they go specific about that free look anywhere?
Free look was a couple different questions around. It was a couple different questions. So I can't say that they asked specifically, but I knew that it was around this section where they talked about the free look.
Okay.
And it gave you options, 10, 20, 30 days.
Okay. So, but the free look period starts when you do what?
And I think that part was on there.
What did you do in order to start the free look? The insurance.
Y'all.
Baruch.
What was provided? What was provided?
Pam said received policy. You didn't receive it. You did what?
You called me?
Huh?
You called me?
Delivered. That's right. Felicia, you delivered the policy. When you delivered the policy, boom, there it is. Consideration. What's consideration, Pam? I mean, Felicia? Oh my gosh.
Felicia, look at my hands.
Money.
And the insured's financial money responsibility is to do what?
Pay
what?
premium.
Right. And the insurance company's responsibility is to do what?
Pay the benefit.
There you go. You have owner's rights. There's an owner of the policy. The owner can be different from the insured. So the owner can do something called assign their policy. What does assignment mean?
That's where they pick the beneficiary.
No, the assignment. They can assign their policy. Absolute assignment. I'm waiting on Pam. Oh, yes, you can transfer it. Yes,
sir.
that's a good word. Good word. Transfer. You can give it over to somebody else. Transfer that policy. You got an absolute assignment and you have a collateral assignment. What's the difference? Baruch, what's the difference? We're going to be moving to
What's the
benefit.
question again? I'm sorry.
You can do an absolute and a collateral assignment. What's the difference?
Absolute and collateral. Ooh, that's a good one.
Keisha Carter, I'm waiting on you to type something in.
Think about what absolute means. What does that mean?
If you can
you can what?
Pam used, you can transfer that policy. Now you got an absolute transfer. What does that mean?
Absolute.
That is going to transfer no matter what? I don't know. Like absolutely is. I don't know.
Okay.
Oh,
Somebody else, come on, come on.
oh, okay. So absolute assignment is going to be transfer all rights of ownership to another person, and collateral assignment is going to be transfer of particular rights to another person.
Yeah, partial. You can partial right.
Oh,
It's only going to be
partial.
there for short amount of time.
All right, gotcha.
Because you probably have some debt.
All right.
So if it's absolute, can I go back and can I just do it for 5 years, all of it to that one person and then take it back?
Good question.
No, I cannot. Very good, Pam. Because why? Because once I do it, it's what?
You can't change it.
Can't change it, but what's that term? Permanent.
Permanent.
It's permanent.
Permanent in total. Complete. Done.
And so when you think about collateral assignment, think about collateral assignment. When you buy a car, do you own it while you're making payments?
No,
What's the collateral?
the car.
The car is collateral. So this is the same with this. This is a collateral assignment. Once your debt is paid off, do you get your policy back? Yes,
Yes.
no, yes.
Yes.
Nobody's answering?
Yes.
Yes, yes.
Yes, Pam said yes. Very good. All right, so now we have beneficiaries and beneficiary designations. Everybody understand the difference between a primary beneficiary and a secondary beneficiary?
Yes.
Okay, then they're going to talk about revocable and irrevocable. Somebody give me one. What's irrevocable? Come on. What's irrevocable?
Irrevocable is you need consent to make any changes.
There you go.
And revocable is you have to change the beneficiaries at any time.
That's right. The owner has the right to change that beneficiary anytime. Again, these are things that you're talking to the insured or the owner of the policy about. You are sitting here as the agent. You're letting them know that you can change your beneficiary at any time. And if no beneficiary is named, then what? Where do policy proceeds go?
The state.
That's right. Then they may have on your test that common disaster clause. Was that there? You said that was there?
Yeah, if there was no beneficiary, that's on the test. Where does it go?
All right. Now, what about common disaster? That common disaster, 2 people in the same accident.
Then it pays out based on, well, it doesn't have a way of determining who passed away first.
Okay.
And what is that then? That's a different name. Common disaster is what Tanya said earlier, when the insured and the primary beneficiary died the same accident.
Yeah,
So the second thing is what you just mentioned, and you mentioned the word for what it was.
I mentioned the word from what it was.
Yep. You said they couldn't determine who died first. So what's the title of that? What's the name of that?
Um,
You got it, Pam? What is it? D. You said the word. Start with D.
beneficiary,
D. D.
the, um,
D is in D.
Go ahead, just tell her.
death,
Just tell her. Determination issue. So remember, if people die and the insured and the primary beneficiary dies in the same accident, that's just common. That's a common disaster, right? The second one is they don't know who died first, so they got to create the beneficiary, and that's the determination issue. And then another one is where simultaneous death, and they're going to presume if people die simultaneously, but they're going to presume who died first. And the proceeds are going to go to the contingent. Do y'all know who that is?
contingent is the,
No, or do you know what that is?
that is,
And just so you know, they did have one of these on this test.
a second or third beneficiary.
So what is it called?
Okay. Is that one the common disaster?
No, the common
Yeah.
disaster is already done.
Oh, we already done with that. Okay.
We're already done with common disaster. That's when, and I'm gonna keep repeating it, that's when the insured and the primary beneficiary die at the same time. That's common.
Right. Okay.
Got it? Yep.
Yes, ma'am.
And then determination issue is they got to determine, because they don't know who died first.
Okay.
They got to make a determination, just like Felicia said. So that's a determination issue. But what is it when simultaneous death occurs and the proceeds, and they presume the beneficiary died first?
Mhm.
What is that called?
I don't know that one. I don't have that in my
Isn't
notes.
that what's called the contingent?
Nope.
No,
The proceeds are going to go to the contingent, but that's not what it's called. It's called uniform law.
uniform simultaneous death law or uniform law. Yeah.
So somebody in a uniform has got to make a decision.
Uniform law. Okay. Let's see that.
Or they may put it all the way out. I don't know if it's gonna be uniform law or uniform simultaneous death law, something like that, but it's a law. If there's a misstatement of age or gender, what are they going to do?
Oh, there you go.
They're gonna adjust it based off of what you corrected it to.
That's right. No, what? Wait a minute. What will they do if there's a misstatement of age or
They're gonna just adjust everything to what it's supposed to be.
So that they adjusting them.
which what are they gonna adjust?
The premium,
They're gonna adjust
Oh, the premium.
premium,
Okay.
or they're gonna adjust the what?
the, um, the benefit.
That's right. So on a life insurance policy, more than likely, they're going to adjust the death benefit. And in a health insurance policy, because that's something they can catch right away, they're going to adjust the premium. All right, so when you have a loan, what are they basing that loan on? If you take out a loan on a policy, what are they basing the amounts on?
Cash value.
That's right. They're basing it on the cash value. And so does that mean that you had a temporary policy or a permanent policy?
Permanent.
Very good.
Yeah.
All right. And then they have something called automatic premium loans. Automatic premium loans.
It's a guaranteed loan, correct?
Guaranteed loan. Automatic premium loans. What do they do? Automatic premium loans. What do they do? Come on, come on, come on, come on. Automatic premium loans. Come on. Tell me, tell me. It's automatic and it's a premium. And then they say the word loan.
Yeah. What is
Pay to
it?
keep the policy from lapsing.
Help
Yes,
the
it
person-
does.
yeah.
It pays to keep the policy from lapsing. Absolutely. So it'll pay the policy from where? Where does it get the money from to pay the policy, keep it from lapsing?
The cash value that you have.
That's right.
Yep.
Automatic premium loan. It prevents the policy from unintentional lapse, but it only comes into play after the what period?
The
What had to pass first before it kicks in? Something had to, no, not 6 months.
60,
Okay. Huh?
60 days.
But don't think about days. Think about what it's called. What is the period that's called when you don't pay your bill?
The after it lapse.
Okay,
30
what's that called? There you go.
Grace period. That's
It's
right.
called the grace period.
So we get a grace period. We get a grace period on our bills and when they're due. So now here we are with a grace period. After the grace period comes the automatic premium loan. But
How long
the
is the
grace
grace
period
period?
had-
Tanya, ask them how long the grace period is.
yes, how long? That's right. 30, 31 days. How many questions do they have centered around the grace period?
They had at least two, at least one. Let me just say that. I know the grace period, I had to respond to that with that it was a grace period and with the amount of days.
Okay. All right.
What comes after the grace period that you were saying? I was trying to write it down.
Automatic premium loan.
Okay.
It only takes effect after the grace period.
So it would occur on day 32.
Okay. All right.
And the automatic premium loan protects it from lapsing, right?
Yes.
And where does that money
Money
come
comes
from?
from the
Cash
Cash
value.
value.
cash value.
The cash value.
There's a term called incontestability. What does that mean? And what numbers go with it? That's all I'm gonna ask. Incontestability. What does it mean? Incontestability. What does it mean? All right, before I go there, let's go to reinstatement. What's reinstatement?
Wait. She says it.
Okay.
Insurance.
Prevents insurance from denying a claim. That's right. I'm gonna go with those words. I'll let those go. Very good. How many years?
2.
2.
Years.
What did she say the incontestability was again?
Prevents the insurer from denying claims
Alright.
Okay,
after the policy is enforced for how long?
2 years.
For 2 years.
so they can use the word contest. They may use the word contested. That means that they can contest this death benefit, this claim. If it's before your 2 years, they're like, you didn't tell me about that heart murmur. Right? You die of a heart attack before 2 years, they're going to contest it. They're going to investigate. They're going to look at it. After the 2 years, you die of a heart attack and you had that heart murmur and they didn't find it. It don't matter. The 2 years have passed. Incontestability. So the incontestability provides clause prevents an insurance company from denying a claim due to statements in the application after the policy has been enforced for 2 years. Reinstatement, how long?
3 years.
3 years. Reinstatement, 3 years. Do I have to provide proof of insurability?
No.
Yes, it is.
Yes.
Oh, yes. I'm sorry.
Okay. If
And
I
do you pay back any of your premiums?
Yes, you do.
yes, all, right?
All of them.
And remember, on anything that's reinstatement, bringing something back, they're gonna check because they want to make sure that you're not just getting this policy because you're sick now.
Mhm.
All right. So reinstatement is probably the only thing in this book, besides when you get the policy at the beginning, that somebody's going to be checking your health later on. So if I reinstate this policy, then I have to provide proof of insurability. Riders, going to riders now. Accidental death and dismemberment rider. That may still be on there. They have 2 terms that go with accidental death and dismemberment. Those are principal sum, capital sum.
Mhm.
You remember that from yesterday, Felicia?
I do.
Mommy.
So the principal sum pays the face value, capital pays the percentage. If you
So when you think about accidental death and dismemberment,
if you lose body parts, it has
okay, so principal sum is for what?
the principal sum is for 2 or more loss of body parts. And
Right.
the capital sum is if you lose one, it pays a percentage. And it has to be within the 90 days of death or the accident. Well, yeah, death within death or the dismemberment.
How many days?
90.
Very good. Guaranteed insurability.
Allows the insured to purchase additional coverage every 3 years. Premium goes up and no one protects premium.
And the premium goes up. And no evidence of insurability is necessary, but very good. Another rider could be an accelerated benefit rider. I'm not sure if that was on there. What does it do to the death benefit?
Decrease.
Huh?
Decreases.
It decreases the death benefit. So the accelerated benefit is early payment of a part of the death benefit to the insured from the insurance company for qualifying medical expenses. What else did they have around that? Anything you remember, Sherry?
No, just paying out early.
Okay. Anything on long-term care that they may have had?
Mm. Like I said yesterday, Sabrina remembered more about long-term care than I did. I didn't remember so much about long-term care being on there.
So anything on long-term care, you got to remember that it's guaranteed renewable. There is a waiting period. There is a 90-day elimination period. 90-day elimination waiting period. There's a benefit period and it's guaranteed renewable. That's probably about all that we're going to look over right now. Now we're going to look at those options. I'm only drilling one. I don't care about your dividends, nor really your settlement options. You got to know non-forfeiture. You got to know non-forfeiture. Non-forfeiture is cash, extended term, and reduce paid up. Cash, extended term, reduce paid up. Non-forfeiture, you cannot forfeit this cash value. You can give it up. Say, I don't want to pay the premiums anymore on this policy. But if there's cash value in here, the insurance company is knocking down your door to say, what do I do with it? You can't forfeit it. You got to tell me what to do. So when they say cash, what does that mean?
That you have some money that you could get,
Okay.
or
Yes.
money that you can get. You either oh my gosh, I know we did a whole math problem on this. I think, didn't we? Or something similar to a math problem?
Something kind of similar, but what are we gonna take? What, so you say we get some money. What is the money? What is it?
It's the
What we
see,
already answered that.
um,
We already
So just
told you.
remember on the policy, there's an option that goes along with it. And so on this policy, on this option, you can have non-forfeiture options, meaning non-forfeiture. We ain't gonna forfeit nothing, right? So 3 ways that you could actually do this non-forfeiture option. The first one is what? If I want to just take all my cash out, what is it?
Cash surrender.
It's a cash surrender.
There you go.
If I want to take all my cash out, that's cash surrender. I'm surrendering it. And that's my cash surrender.
And when you cash surrender, you have ended the policy. You can't come back. You ended it. It's done.
right.
Over. So what happens then if I just want to take my current cash value and convert it to a term policy? What is that called?
Good question.
Extended term.
Very
That's it.
good.
Extended term.
Now, what is the amount of the death benefit?
Whatever it was with the other policy.
Absolutely.
So if it was 100,000, it would still be 100,000.
Yep.
Right.
Okay.
And then on the other one, then what if I want to take the cash value and use it for just a single premium to purchase something that's paid up?
So you would use the, okay, so if your cash value is 5,000, you use that to pay for you use that to pay the premium of a new policy. And
How much is that policy going to be?
it's just going to be worth what you paid,
Which is, how much did you just say?
5,000.
It's 5,000. What is that called?
Um,
Reduce paid up.
Reduced paid up.
reduced paid up. But it don't have a cash value to it, correct?
That new
Well,
policy,
it does, but it's gonna be less than what the policy is worth.
your death benefit is gonna be less.
Right.
That's all. You just bought a new policy with what you had, and so you don't have the 100,000 anymore. You got a new death benefit.
And how long does that
But
last?
it is a whole life policy. What'd you say, Sherry?
How long does it last?
Until your death?
It's lifetime.
Right.
Yeah. And absolutely, yes, there's going to be the calculation on the test. That whole grid is going to be there. And you're going to have to identify, they're going to ask you questions, or a question, maybe two questions based on whether if it was an extended term, what would it be?
Okay,
Or if it was a reduced paid up, what would it be?
I could see the slide in my head. It's on my computer too, I just have it printed and I
Go
was,
back and look at that again, because that is absolutely on the test.
okay.
So again, I'm not teaching dividends because you know 3 words that go with non-forfeiture. So when you get over to, and they got a question in reference to dividends, they're either gonna give you the, what is it, CRAPO, the acronym CRAPO for dividends, or they may give you a question and it may have some of the extended term or reduced paid up as an option. You'll be able to eliminate, get down to 2, move forward. Settlement options. Settlement options is dealing with what? Settlement option.
Cash, life income, interest only, fixed period and fixed amount.
That's,
Cliff.
but it is the what? A settlement is what? The money from what?
Death benefit.
That's right. It's the money from the death benefit. So if you can remember that, then Cliff, for these, you're going to be able to answer. And again, your options, A, B, C, D, that they're going to give you are either going to just be all about settlement, or they'll include some words from the others. We've given you enough to pass, and pass with a high score inside of the policy provisions, options, and riders section. Because if a non-forfeiture is on there with the chart, then obviously they want you to understand non-forfeiture more than anything else. Dividends. Dividends are the excess premium. Dividends are the return of excess premium. Settlement is the death benefit, and non-forfeiture is dealing with the cash value. When you deal with questions on your exam regarding taxes, the only time that you're going to pay taxes on something is if you're in excess, right? If something is in excess. Oh gosh, I forgot the other word I was going to use. And then if you paid more into something, excess and interest, excess and interest is more times of what you're going to see that you're going to pay taxes in. So there could be another question when we're looking at taking out money from your policies. They compare it to how much money you put in. How much premium did you put into this policy? If by chance your cash value is more than your premium, what you put in every month, your cash value is more, then when you subtract the two, you got to pay income on the difference. That's only if the cash value that you're taking out is more than the premium that you put in. All right. Okay. Anything else we need to go over, Sherry, in that particular section, or anything that you think that they really need to have from that life section? And I know we didn't cover everything, but any key things that you would say, oh my gosh, they had this on here 5 times, 4 times, 3 times.
Well, the only thing I would think that you want to make sure that everybody understands is the waiver of premium, because that was on there under for the life insurance riders, the waiver of premium that was there. And so everybody just needs to understand that if somebody, so can anybody explain what the waiver of premium is? How it works? And I know that that's going to be in something else too, but just make sure you know that. Waiver of premium.
Come on, somebody tell us what waiver of premium is.
Waiver premium is a disability rider.
Yep.
Very good.
And so
The way it waives the premium for the total disability after a waiting period.
What's the waiting period? How long is the waiting period since you're reading it?
6 months waiting period.
Very good. Yeah, 6 month waiting period.
So
Yeah.
just remember that part, because that'll come up a couple of times. And I think that was it.
Now, again, when we look at this, when we're looking at it, we're talking about the areas, again, what that weigh the most. I got to get as many points. So we're focused on types of life policies. We're focused on policy provisions, and you should focus on the state. Now, the state has the common laws that's for everybody, no matter where you are. The basic difference is there's some key things. Number one, how your commissioner got into office and how long is his term. And if he dies, sometimes they ask you if he died, who replaces him. But the other piece that people miss are these questions, because they ask specific questions pertaining to life insurance only. So you got to know about replacement. Replacement, when you are replacing an existing policy. There's 4 steps to replacing an existing policy. When a policy is to be replaced, how long must the insurer maintain copies of all the written communication? So
3
the
years.
company, that's right, 3 years. Who is responsible for the content of all advertisement?
The insurer.
That's right. Always. The advertisements are always the responsibility of the insurer, regardless of who wrote, created, designed, or presented. It does not matter. The insurance company, it's their responsibility, regardless of who wrote it, regardless of who created it or designed it or presented it. And how long must the insurer keep files of all advertisements?
4 years.
4 years. So if you don't know the 4 steps to replacing a policy, I'm going to tell you what that is now.
It's 4. I thought it was just 3.
No. There's 4 steps that the
Okay. Oh,
producer,
I guess 3.
the producer must follow. 4 steps that the producer, that's us. The producer is us. We're the agent, the producer. So 1, give the applicant a notice regarding the replacement. Give the applicant a notice regarding the replacement. 2, you got to obtain a list of all the existing life insurance policies that's going to be replaced. See, the insurance company got to make sure that this is not to their detriment, but to their benefit. Because they don't want you twisting and churning. Look up your definitions. Number 3, huh?
I just said twisting and turning.
Number 3, give the applicant the original or a copy of the written or printed communication used for presentation to the applicant. So you got to give them that communication that you presented in writing. And you can't just replace it and not tell the insurance company that they had before that you replaced it. You got to let them know. So you're going to submit the replacing insurance company, going to submit to the replacing insurance company with a copy of the application and a copy of the replacement notice. They got to be notified that they're in something else. That's part of your job. So when you replace, number 1, you're going to give the applicant a notice regarding a replacement. Number 2, you're going to obtain a list of all the existing policies to be replaced. Number 3, give the applicant the original or a copy of the printed communication. Number 4, submit to the replacing insurance company them an application and a copy of the replacement notice. They must be notified, and that's your job. So those will be there and centered around pertinent information to types of life policies only. Again, is going to be about replacement and advertisement. Pertinent information regarding health insurance companies is going to be around long-term care supplements. Let me get those for you. They'll have some miscellaneous provisions. They're going to be dealing with a newborn child, a wellness program, and the age 26. There'll be things around the Medicare supplement and long-term care. I'm going to give you 4 specific things. These are life insurance rules and regulations pertinent to accident and sickness only. Within what time frame must an insurer pay a claim? That may be different per state. Time payment of a claim. In Georgia is 30 days. Within what time frame must an insurance company pay a claim? In Georgia, it's 30 days. In some states, that number may be different, Pamela, so you need to look that up for your state. How long is the free look period on a Medicare supplement policy? How long's the free look period for a Medicare supplement? Somebody give me the answer. Does anybody know?
Isn't it 45 days?
Too long,
30.
30 days. A long-term care policy is a guaranteed renewable policy. Long-term care policies must be guaranteed renewable. Sherry, be prepared to do those three.
Which three?
Guaranteed renewable.
Oh, yeah, guaranteed renewable, guaranteed insured, and guaranteed issue.
Yes, okay. And then what are the producer's training requirements to sell long-term care? So Pam, we went over that yesterday. If a person wants to sell long-term care, what are their requirements?
They have to have so much more what?
Baruch, do you remember?
How many hours?
I got long-term care policies must be written as guaranteed renewable.
Yes. And then if you want to sell a long-term care policy, what are your requirements as an agent?
8 hours of continued education.
That's right. 8 hours of continuing education,
It's good for 2 years.
and it's good for 2 years. And then what has to happen next?
4 hours renewal.
That's right. And then you got to take 4 hours continuously from that point further. Sherry, what else?
For what time?
I'm getting to it, just a second. Are we talking about group health right now? I don't want to confuse everybody.
I wasn't. Did you think it was necessary?
No, I was just asking. I'm just going through everything, so I just want to make sure. So, since we're talking about the guaranteed, renewable, guaranteed, insurable, guaranteed issue, what is guaranteed renewable? What does that mean?
It means that your policy is guaranteed to renew every year with the premium going up.
Correct. And so what is guaranteed issue?
Guaranteed issue, pretty much you're guaranteed a policy
You're guaranteed a policy.
and everyone can get it.
Yep.
Well, everyone is covered.
And you remember so just remember the guaranteed part. Guaranteed meaning absolutely. It's guaranteed that I'm going to be able to do it. You just want to make sure and remember the other. And then the other, what did I say? Guaranteed insured. What is guaranteed? No, I said it. I did all three, right?
Guaranteed insurability, guaranteed.
Insure. I
and
did
guaranteed-
insurability, issue, and then renewable, right?
Yep. All right. Those words, guaranteed issue. Guaranteed issue. If you see guaranteed issue, it's going to go with Medicare supplements. The first 6 months a person gets is guaranteed issue, meaning that they can get into this policy and nobody cares about their health that first 6 months. Nobody's going to ask them any health questions. They don't care. They don't care if they're on the deathbed. They don't care. They're going to give them the policy. Health doesn't matter. Guaranteed issue. And then you asked a question yesterday regarding, is it all or some or something? However, you said it yesterday.
I did.
Yeah.
Let me see what I asked. For that,
I think so.
Nope. I don't know where I asked that question, Tanya.
Okay, then we have guaranteed issue, guaranteed renewable, guaranteed renewable policies that they're going to focus on will be Medicare supplements and long-term care policies are guaranteed renewable.
I can't find where I was.
I'm not sure what else. Okay, we did not look at group insurance. We did not look at taxes. We did not look at Social Security. We did not look at those things. You are still to review and skim over those items. Review, get through it. Go over those items. We went over what was important right now to get the most points. I'm going to say ace it. If I ace it, then I am going to pass this test. So if I understand everything about types of policies, both on life and health, if I understand everything there is about the policy provision section on both life and health, and I understand the state, I just need to get a few right under that underwriting. And remember, underwriting is going to be the same for life and health. They're going to have the same kind of questions. The only thing different on delivering the policy for health is that, hey, or binding it, let me go that way, is that the insurance company is going to be approving it. They don't care that you pay a premium. It's only going to be approved when the insurance company says so. That's one. But Fair Credit Reporting Act and the underwriting and all that stuff, it's going to be the same. So they overlap.
Mm-hmm.
So Tanya, talk about the overlap of free look, because when is free look 10 days? In what type of policy?
You all know? Free look. You know the definition. Free look is 10 days on both your life and health, but long-term care and Medicare supplement have a different free look period.
Right.
So Medicare supplement has a how many day free look period?
30.
30.
And so that's why I wanted to bring that up, just so you guys, so when free look comes up, you know that if they're talking about Medicare supplement, it's going to be a different term. It's going to be 30 versus 10 days.
What was 30 instead of 10 days? I'm sorry.
Free look.
Supplement.
So when the free look is with the Medicare supplements, if it's talking about Medicare supplements, then the free look is 30 days. But on other plans, on health and life policies, it's 10 days. I know on life policies, it's 10 days.
Mhm.
Any questions that you all have? So we went over some things. Now, what do you have? Where are you unclear?
I have a question for y'all. When can I buy more insurance without proof of insurability? What do I have that allows me to do that?
Y'all
Say
already
the
know.
question one more time.
When can I buy more insurance without showing proof of insurability? What do I have that allows me to do that?
Contestability clause?
Is nope.
No.
We just talked about those three things, and one of those three was
Well, let me just say it. Let me say it a different way. What can I buy that guarantees me that I can buy more insurance without proof of insurability?
Oh,
Isn't
So
that
here are my
guaranteed
options. Say it again.
insurance?
Say that again.
Guaranteed issue?
So here are my options. My options are guaranteed issue, guaranteed insurability, or guaranteed renewability. Renewable. Renewability.
Guaranteed issue.
guaranteed insurability.
Guaranteed insurability. That's what guaranteed insurability is. So since we're talking about guaranteed issue, what is that?
You're guaranteed to be issued insurance regardless of your health.
Regardless of my health. Okay. Great. Well, then what is guaranteed renewability?
You're guaranteed the policy.
Guaranteeing the policy to be renewed.
and what's going to happen to the premium, or what could happen to the premium,
Go up.
and do I have to provide proof of insurability?
No,
No.
no proof on none of those.
Okay. So if I as an agent, I'm going all the way different. If I as an agent go and deliver a policy and gives you a receipt, first, what kind of receipt is that? And second, when does my policy begin?
Conditional receipt, and the policy begins once you delivered it.
Yeah. That was just random. Just random. Very good. There's something we talked about. So today we also talked about the term lack, not the term lack, but we talked about lack. And it's important to know what all four of those components are. What do they consist of?
Legal,
LACC.
I'll do it
legal,
last. I know what lack is.
Legal agreement.
Without looking,
I'm not looking, I'm looking at something
look
else.
up in the sky.
Legal agreement competent and we skip that last C.
That word. It's that
It's
word.
money. It means value.
It
I
means
know
value.
what it is.
Guess what?
All right.
If someone's sleeping in the room and you got the lights on, you should be what?
Um,
Wait.
consider it.
There you go.
Not considerate.
Oh.
You should be considerate, but you're not. Remember that word conditional. That word condition.
Condition.
That word is going to be used. Consideration.
Consideration.
That word is going to be used a couple different times.
Okay. I got to figure out how to remember that one. I always forget that one word. I remember the rest of them.
Okay, you're gonna remember this word, condition. Okay, consideration.
Consideration.
Remember, consideration is value. Any type of value.
All about the money. Consideration, all about the money. Consideration, all about the money. I
So
must
if I wanted to trade my truck in with another truck, the consideration in that is the two trucks.
Value of them.
That's
Okay.
the value.
Okay.
All right.
Mm-hmm. Yeah, I think I got it now.
That one. And I think now, I know that they're going to talk about they're going to ask a question and you're going to have to respond to it, whether it's the Medical Information Bureau, or at least I had to answer a question saying that was the Medical Information Bureau. The options were Medical Information Bureau, Fair Credit Reporting, and something else.
So
But
the
so
definition?
yeah, just remember the Medical Information Bureau. That's
I'd like
that
to throw in that
nonprofit.
terrorism act with those questions too sometimes.
Mm-hmm.
So is it what they just given a definition? You got to pick which one it is.
Yeah, so they asked, they gave a definition and you have to choose which one, whether it's the Medical Information Bureau or the Fair Credit Reporting or something else.
Okay.
I don't remember all that they put on there, but just if you remember that fair credit reporting is to protect the consumer against financial
And
bad
accurate
financial
information
information.
too. Yeah.
Mhm.
Yeah, so remember that. And just know that the Medical Information Bureau is nonprofit.
Claims.
Yep. And I know we just talked about free look, but when does it begin?
Good question.
When does free look begin? And we're not talking about Medicare. I'm just talking about life. But when does free look begin?
It's
I mean, the policy is delivered.
Yep, it's immediate.
Yep. There you go, Pam. That's right. Delivery policy.
Yep, very good.
So you all are really getting a treat. Sherry has walked out of the test, passed, and coming back, and she just keeps her stuff.
I'm trying to keep it. I'm trying to
Yes.
This is helping me just as much as if it's helping anybody else. I know it's helping me.
Sure, we're gonna need another teacher soon.
that again. What?
You're gonna need another teacher soon.
There you go. Right here. So remember, there was something specific about term and versus term policies and whole life. What is some specifics around term?
It's temporary.
Temporary, it,
The premium is less, and it's for a specific period of time.
Does it have a cash value?
No.
No cash value. Term. On your job, on some people's jobs, they have term policies. I still have an issue with that. You don't know it. You don't realize it's term. But you do. Okay, I'm sorry. I digress. How about whole life policies? Are they term?
No, they're permanent.
They're permanent. And how long do they last?
100 years or more.
100 years or till death. Do they have a cash value?
Yes.
Good. Can you borrow against it?
Yes.
Yes. So there is a whole life policy that pays up faster. Which one would that be?
Limited pay.
Limited pay, whole life. Why do you think they call it limited pay whole life?
Because you can pay the premium much faster.
Yeah, because it's shorter time. That's right. Perfect. What if I just decided to pay? What if I just had $100,000 and I want that to be my life insurance policy? So I wanted to pay it all at one time. What is that called?
Say it one more time.
What if I had $100,000? I decided I wanted that to be my life insurance policy and my death benefit. So I'm just going to pay that $100,000 for that life insurance at one time. What is that called? One time.
One time pay.
What kind of premium is it? How many
Paid
premiums did I pay?
Something. Close Pam. Paid. She got paid up something, but it's not
No.
not paid up. It's but
How many,
it's the
how
process.
many premiums did I pay? Did I pay multiple premiums?
No, you pay one premium.
Which is what?
Paid up.
No.
Married or
Exactly, right?
What is it? What is it?
I don't have a girlfriend or boyfriend, so I'm what?
Single premium.
Single.
single.
It's a single premium. I just want to do it one time. It's a single premium. And so we also talked about adjustable life. What's another word for adjustable?
Oh man.
Beautiful.
No, it's not the title, but what's another word for adjustable?
Flexible.
Flexible. Thank you. It's
Okay.
flexible. So anytime you hear the word adjustable, if it's adjustable, it's flexible. So some of the conditions of adjustable life is it's flexible, but it's only a term policy, right?
No,
No? What is it?
it's both. It could be term or permanent.
Thank you. Thank you. So what if it is a term and I want it to be a permanent? Can I do that?
Yes.
I can do that because it's adjustable, because it's flexible, right?
Yes.
How about if it is a term and I want to adjust my period? If I want to make it longer, can I do that?
Yes.
Okay. So the protection time can be modified. It surely can. And I know that, I don't know if all of y'all are going to have this, but just very quickly, we're going to pass right by. What is that rule 72?
How
The
long?
formula?
It's a formula. It's a
It's
formula that, what does it tell you?
How long it takes for your money to double?
yeah.
Okay, and so how do you do it?
You do 72 divided by the interest something
You divide what? Right. What do you
uh
divide?
70
um
interest rate.
72.
wait. Wait. It's
You
right.
divide,
Oh, the
you're
interest
the one
rate.
that
I said
got
it
me
right.
through this test
It's
along with your mama now, so I know you know this.
72 divided by the interest rate. Oh, trust me, I
That's
don't.
it. That's all you need to know.
I
And
don't
that
know.
tells you how long it'll take for it to double. So if you have that on your test, I did. They must have found me, and I think AI is a part of it because they said you should know this. That's what they did. But if you have it, it's just that simple for your calculation. And then there was that universal life policy. Is the premium permanent, or is it adjustable or flexible? Universal life policy. Okay. Maybe
I got minimum premium and target premium.
Yeah, you got that too, but it's a flexible premium. I'm not gonna ask. So there are two options on there that Tanya really wanted to everybody to really understand. Option A and option B. Do you remember what they are?
Yes.
They pertain to the death benefit. What were they?
Option A is level death benefit, and option B is increasing death benefit, and that increases each year.
Okay. Yep. Absolutely. So if they mention on the test anything about a variable life product, what do you know you have to have?
2 licenses.
2 licenses, absolutely. And I don't know if specifically you need to know which licenses. Tanya, you think they need to know that?
One is security, right?
Yeah.
And
Well, you already know it. Yeah. Security, and the other is what?
life insurance.
Life. Absolutely. Absolutely.
It's no guarantees.
Is no guarantees. Absolutely. Because it is anything dealing with securities is no guarantees. And then I do have another question. So say for instance, I had a policy where it paid if the first person died. If it was 2 people on it, but the first person died, what is that called?
Joint.
Joint. Yay. And what would happen if I had a policy and it only paid when the second person, if 2 people are on it, the second person died?
Survivor.
Survivor, because it's all about the survivors after that.
Yeah.
Is an annuity an insurance policy?
No.
No. Oh my goodness. An annuity has 2 different terms. One where you pay in, one where it pays out. What are those terms?
Accumulation and annuity.
Yep. Accumulation and annuitization.
It's about income.
All about the income. Streams of income. And so if it does just on annuity, if it asks about an immediate annuity, what is that referring to?
It's immediate, so they want it they want it within the year.
No,
No, what?
it has something to do with the payments. Remember,
purchase with a single premium.
nope. So remember annuity, remember the lottery. I don't want the lottery and I just want my money. So what does that mean about those payments? When are my payments going to begin?
Within the year.
That's too long. I won the lottery. I want the money now. When are the payments going to begin?
You want the lump sum.
Nope. An immediate annuity is in a set amount of time that you start receiving payments. If I'm getting payments, that's not a lump sum. Within how many days?
Pam said immediately.
No, it's no, but it's 30 days. So that means that I'm going to get it in 30 days. Remember? So if it's just an immediate annuity, if they put that on there, you're going to get paid in 30 days. And that's just like anything else, you would get paid every 30 days. So there are some premiums, some different specified periods of time. And so if I say single premium, level premium, or flexible premium, what do they refer to? What do they mean? What are the time periods? So a single premium is what?
Paid in one?
Yep, one-time lump sum. What about a level premium?
That's a good question. What about it?
Level? What is that? How am I paying my premiums then?
They're increasing? Oh, no, they're the same.
They're the same. They're fixed installments over time. They're fixed.
Uh,
But what if they're flexible?
You could change them.
Change them to what?
change it.
Variable. I'm talking about my premiums. Flexible premiums. They're variable amounts.
It goes up and down.
It can go, yeah, it could be different amounts.
Yeah.
So just remember flexible, variable. Level just means fixed is the same, and single means one time lump sum. So typically there's a grace period for your premium to be due. What is that normally?
Say it one more time.
Typically there's a grace period. Oh Lord. There's a grace period around when your premiums are due. What is that time frame?
30 to
30 to 31 days or
30
more?
to 31 days, absolutely. So if you see on you know that you've got this entire contract, which consists of two things, which is what? I know that you said it like 3 times.
The policy and the application.
The policy and application, that insuring clause is there. And what does that tell you?
That's the information about it gives the basic information, your name, your agent's name, policy type, just general information about your policy.
Right. It's who's paying, the premium amount, the basic information around that, and the amount of the contract. Okay. And then there are some things about, there are some assignments. So there are 2 assignments that you want to group together and know. One is a absolute assignment, and the other is
Collateral.
collateral assignment. Thank you. So what the absolute assignment is, it involves what?
Absolute is going to be all rights of ownership.
What you doing to them?
You're giving it to another person.
Transferring them over. Absolutely. All rights. And is that, can you just, when you do it absolutely, is that just temporary?
No, it's permanent.
No,
That's
yeah, it's
permanent. Absolutely. Well then, okay, so what is collateral assignment?
You transfer the partial rights.
Part of the rights. It's not going to be all of it. And is that going to be permanent?
No.
It's It's only temporary, right?
Mhm.
So just remember collateral. That'll be easy to remember because you think about collateral on your car being collateral or your house even being collateral, whatever.
Paid off.
Yep, till you pay it off. When you pay off the loan, then there you go. Does anybody know the difference between a primary and a contingent beneficiary?
The
Yes.
the primary beneficiary is the, you should say the first beneficiary, and the contingent is the second.
Okay, yeah,
And in
absolutely.
order for the contingent to get payment, the primary has to die before the, insured.
That's right. That's right. Very good. And then
What is something that protects the contingent beneficiary?
that protects. I don't know that one.
We went over something, I can't remember what it was, but we went over it last week.
Oh, I know what you're talking about. You're talking about those, you're talking about the protections, such as, what are they called, Baruch? The clauses that are out there?
I was talking about the common disaster clause.
Right.
Yeah.
So it's protection for the contingent to receive the proceeds. But what is a common disaster? Because that doesn't protect the contingent, but what is common disaster? What does that mean? Common disaster clause.
As if both the beneficiaries died at the same time.
Both beneficiaries or who? Be specific on that one.
Not both beneficiaries, both of the insured.
The insured and who else?
The insured and the beneficiary.
Okay, so if they die at the same time in the same accident, that's common disaster. So what happens if we don't know who died first? Either the beneficiary or the insured.
They have to issue a determination and a uniform.
Look at you. Did you say a determination? What you say, girl? I love it. I love it. Very good. So now then, what happens if the beneficiary died first, before if simultaneous death presumes that the beneficiary died first, where does the money go and what is that called? Maybe Baruch, that's what you were talking about?
Yeah, maybe.
Well, what's it called?
Say it one more time for me.
So what if the simultaneous death law presumes that the beneficiary died first?
I thought that was like, does that got to do with the uniform law?
That's the uniform law. Because it protects who then?
Okay.
Who does it protect? And where does the proceeds go? You said it earlier.
I sure did.
Sure did. Who's after that primary?
Oh, wait, what was the question again?
Let me see
I was about to
how
say it protects the contingent beneficiary.
it does. It protects the contingent beneficiary because that's where the proceeds are going to go. Because they don't know who died first.
I didn't say much, so I know it was something.
It's all right. So if you hear the word incontestability, if you see that, what does that mean to you?
It prevents the insured from denying claims.
That's right. Give me all my coins. All my coins. And then when does that go in force? When is that
2 years.
enforced?
2 years.
2 years after the policy is enforced. Absolutely.
And they
And
have
if
30 days
we,
to pay.
I'm sorry, say again?
And they have 30 days to pay.
Yep, they got 30 days to pay. And if for some reason our clients make a misstatement on their insurance policy, what happens there? What would the insurer or the insurance company do?
It would tell them to write like a whole application over.
Oh,
Well, if they don't catch it within a certain amount of time, they still have to pay out the death benefit.
so what happens if there's a misstatement, let me just be more specific, of gender or age?
It will
Let's just
adjust premiums and benefits.
they'll adjust. So if it's a life insurance policy, what would be adjusted?
The benefits.
And if it's a health policy, what would be adjusted?
Oh, I don't know.
The premium. Very
Okay.
good. Got it. Perfect. Perfect, perfect. If I just decided to give up my policy just voluntarily, what is that refer
Cash
to?
surrender.
That's a cash surrender. But if I just decide not to pay my policy, my premium, and it does what?
Gonna lapse.
It's gonna lapse. And so that's it, right? Can I do anything with that old policy?
You can have it reinstated.
I can. Oh my goodness. How long do I have for that to happen?
3 years.
Yeah.
I got 3 years.
Good
And
job.
I'm just gonna come back in. Are y'all gonna ask me any questions about my health?
You need to show proof of insurability.
And you
Absolutely.
have to pay all of the past premiums.
And I gotta pay them all. Man, insurance companies no good. Yes, they are. Just joking. All right.
I like this.
What?
Yeah, we doing right here. I like this.
Yeah. So what if we had this rider where what if we had a rider on our death and accidental death and dismemberment? There are two ways that they're going to assess this. There are two ways. What are those terms? I'm gonna see.
Double indemnity and triple indemnity.
No. They wouldn't give us triple indemnity, I don't think. But anyway, if I lost use of one of my arms, what would that be called? I just lost use of one of my arms. What is that called?
Capital premium.
Capital what? A premium is a payment.
Capital, not premium. Capital sum.
Capital sum, absolutely. Well, what if I lost an extremity? A whole extremity. A whole arm. A leg.
If it's just one, it's still capital, but if it's more than one, it's
what?
Premium.
Principal.
Premium is a
Principal.
payment.
Principal
It's a
sum.
principal sum. And thank you for saying that because that was a trick question. I just wanted to see if y'all would know that it would be two extremities.
It has to be two or more.
One more. There you go. I was trick question. You got me. They're good. Thank you. Okay, so an accidental death and this so what about not accidental death, I'm sorry. So on my disability riders, which you're gonna have a couple questions, they're gonna bring up disability a couple different times. But on that, there is something where if I'm disabled and I might not have to pay my premium, what is that called?
Waiver premium?
It's called waiver of premiums. So now I just got disabled in March, and in April I don't want to pay my premium. Is that right? I don't have to pay it, right?
Say that
Yeah.
again.
I just got disabled in July. It's July now. It's June. June I got disabled. My premium for July is due. Do I have to pay my premium?
Yeah, you do. You have to still pay it for 6 months.
Very good. For 6 whole months. Darn. I needed that money though. What's going to happen later?
You'll get it back after 6
I'll get it
months.
all back. Okay, great. I just want to make sure I was going to get it back. Yep, that's right. Very good. Let's see. Oh yeah, there's another rider that's really important to me. Um, and it's called if I had, wait a minute, let me see how I wrote this. Let me just be clear. What is, I don't know how I wrote this. I don't want to ask that question because, so tell me about an increased death benefit rider. What can you tell me about that? What is that connected to? Or tell me about that.
You said what? What was it?
An increased death benefit. When does that come into play? Well, let me just say this because I think I wrote all kind of crazy notes. I'm sorry. So when is it possible for me to have additional coverage on my insurance that I can buy additional coverage? I already asked this question before.
Guaranteed insurability?
Guaranteed insurability. So, but when I do this, the only reason I don't really want to do it is because I have to go and get a health, I have to do a health thing because I gotta prove my insurability, right?
Right.
You sure?
No, not if you're guaranteed.
That's right. I'm guaranteed, so I don't have to show it. I don't have to do insurability.
Why do I have written down here no one protects premium? What does that mean? Nothing? Can I scratch that out if that don't mean anything? That's what I have here. No one protects premium. I don't know what that means.
I don't know, Tanya, you know what that means? No, she doesn't know what that means either.
Okay, good. I'll scratch that out and then I'll put don't have to show, what was it? Proof of insurability?
Right. No proof of insurability. And how often can I do that?
Every 3 years.
Every 3 years. I sure can. Let's see. What is it called if I decide that I need to take some money out off of my death benefit before I die? What is that rider called?
Accelerated living benefits.
It's go the opposite way. Oh yeah, that's right. I'm sorry. That's exactly what it is. That's exactly what it is. And so what exactly am I doing with that? I just said it, but tell us a little bit more about that.
It's about long-term care riders, and it decreases death benefits.
It decreases the death benefit when I have to reduce it early. And usually the insurance company will allow us to do this when what is lost from me. I know we didn't go over the term daily living.
We become critically ill.
Yep. So we didn't talk about this that much this time, but I know that you have to lose how many functions? How many what?
I think it's 3.
It's two.
2.
It's two functions of your life that you for two activities of daily living is what it is. And so you have to lose two functions, like you know,
You can't eat,
yeah,
walk.
can't eat, can't go to the bathroom.
You need help doing stuff you should be able to do every day.
Right. And so that's why it would make sense to be able to. Um, you had something, Baruch. Oh no, never mind. I had a note on here that says long-term care is a rider. Okay, thank you, Tanya, because I was like, why did I? And that was just like on one line by itself. I don't even know why I wrote it. Okay.
Yes, it definitely can be a rider on a life insurance policy.
Okay,
The accelerated death benefit, so can long-term care.
got it. Okay, thank you. All
Mhm.
right. Okay, so there are going to be some options. There are going to be some options, and the three options are called non-forfeiture, dividend, and settlement. But for the non-forfeiture options, so think of that word, non-forfeiture options. In a whole life, there are three options that I have listed here with no glasses on. What would it be if I decided on this, if I decided to stop paying for my insurance, I'm not gonna pay the premiums anymore. What would that option be? And I took the current cash value and converted it to a term policy.
Cash surrender.
Oh, I took the cash value and converted it to a term policy.
Oh, extended term.
That's an extended term. So on that extended term, I only had $23,000 worth of cash value, and my policy was $50,000. So what is my term life policy going to be?
Reduce, paid up.
So what's the amount?
Still 50,000.
It's still the same thing.
It's still 50,000. Thank you. Okay. What if I just decided I had $12,800 of cash value and I decided I don't want to pay anything else? What could that be considered? I'm not gonna have any more insurance. I just decide I'm gonna take cash value and be done.
That's the surrender of cash.
That's surrender. That's cash surrender value. That's right. That's the surrender. And then if I decided to take the cash value and use it as a single premium and buy a policy with it, because I've got $48,000 in that cash value, and I'm just gonna buy me a premium with it. Not a policy with it. What is that called? My original life insurance is $100,000. I have $48,000 cash value. I'm gonna take that cash value out and I'm gonna use it as a single premium to buy me some insurance. What is that called? You said it earlier, Baruch.
Oh, extended term.
Nope.
No, reduce, paid up. I'm sorry.
Yes. It's,
Yeah,
you
I
know,
know which one. I know which one. Just
I know you knew that.
reduce
Um,
paid up.
but dang it, how long does that last? Is that only gonna last for a short period of time?
It's
It's
gonna
no, it's gonna last the longest.
It's gonna last a lifetime. It is. If you hear anything about dividends, is it guaranteed? Are dividends guaranteed?
No.
Okay, they're not guaranteed. And so, is it a return of your premiums
Yes,
or
it's return of excess premiums and it's not taxable.
okay, thank you. Absolutely. Um, and for settlement options, there's a man's name that I will carry with me as I know I carry him with me.
Cliff,
That is Cliff. Cliff, my guy. Cliff is my guy. What does Cliff stand for? For these are settlement options. First of all, settlement options are is refers to what?
how you gonna settle the policy?
The the death benefit.
Death
How's
benefit.
Yep, when somebody dies. So if I know that my settlement options for my death benefits, I have five options, and his name is Cliff. So what are those options?
Cash,
Cash,
life income,
life income,
interest,
interest.
fixed, and fixed period and fixed amount.
Okay. So thank you. Those are absolutely correct. So when I take my interest, am I going to get my interest and some of my premium back? Or what am I getting there?
Just interest.
It's only that's a trick question. I just want, and it's just to know that it's just going to be interest only. That's it. Um, so what if I decided to do a life income? What does that represent?
And then you get paid for the rest of your life.
Yep. I'm going to get paid some guaranteed installments. They're going to be the same, guaranteed amounts for all my life. And if I'm the beneficiary and I decide to do that cash payment, how much am I going to get taxed?
You're not.
I'm not. There's no tax on it at all. Okay. And so for the fixed period installments, how long does that last?
For every certain period you pick, right?
Right? And then, but what happens? How long does that last for the money part? Well, I mean, if I pick 40 years and the money runs out before 40 years, what happens then? Say again?
that it just runs out.
It runs out. So that was a terrible way for me to describe that, but it just really that's until the money runs out. Okay. So Cliff is my friend on them settlement options.
Was contributory, not contributory on there at all?
It was, and I'm about to go there. I'm about to go there. But Baruch, before you answer this question, because I know you might know this, we left this yesterday with Felicia, and I gave her a specific way to remember contributory and non-contributory. Do you remember those ways, Felicia?
Yeah, you said alphabetical order,
I sure did.
and it's the same with the percentage because contributory is 75%. That means both you and the I guess employer contribute, and non-contributory is 100% the employer pays.
The employer pays
So it's the
100%.
they put in the alphabetical order.
Yeah. Okay, Baruch, I'm sorry, but that's how I had to do it on that one.
No, that's actually wonderful because I'm trying to figure out how I'm going to remember that. So you good.
Because C comes before N. C becomes contributory goes before non-contributory. So 75% is lower than 100. That's how I remembered it. That's how I wanted to put it together so that I wouldn't forget what that was. Yep, yep. And that what it truly means is if I'm contributing, the company only has to make sure that at least 75% of their employees have insurance. But if the company is doing it himself, if he paying for everything, then he got to make sure everybody's got it because he can't just do some and not the other.
Mhm.
That's the real life on that one. But yeah, very good. Um, there were Now I know we didn't talk about I have notes for qualified and non-qualified retirement plans, but I
Yeah,
don't.
can we do taxes and retirement plans?
Sure. We can do retirement plans. I'm gonna let your mama do taxes. I don't know about that one so much. Okay, so do you know then some of the components of a qualified plan, retirement plan?
Qualified plans has a tax advantage.
Yep, they do. Is there a requirement for time that someone's on a job if it's a retirement plan? Because these are plans on a job. So is there a specific time that they have to be there in order for them to be able to get the benefits from it?
Uh, yeah.
The term that I'm talking about is vesting. So what are the vesting? They have vesting requirements, meaning if you go to work for a company, sometimes they make you be there for a year before they will actually give you money, add money to it also. Okay.
Okay.
And does a qualified plan, does it benefit the company or the employee
Benefits the employee.
exclusively? Absolutely. And then the only notes I have here on non-qualified, do you have notes on that already?
No, I only got the definition of qualified. I don't have nothing for qualified. I mean, not qualified.
So for non-qualified, uh it's not subject to participation. All of the rules that apply for qualified does not apply for non-qualified. It and it doesn't have the same tax benefits as a qualified plan has because it only accept contributions after tax. And the other note that I have on here is there's no government approval that's necessary for it. I don't remember that being on a test, but just knowing it helps. But I will ask you the difference between a traditional and a Roth IRA. I will ask y'all that.
Yeah, I don't have to get my other notes. Hold on.
There was something, Tanya, on the test about a Roth IRA, not a traditional, but it asked, I know that was there. But again, that's only one question, probably, so don't get hung up on it. But Felicia, do you know anything about traditional versus Roth?
No, ma'am.
Just off the top of your head? Okay.
So is that question going to be centered around taxes, or is it going to be centered around the qualified, non-qualified?
It's not, yeah, I think it's gonna be around taxes, where you get your tax benefit from. Because I know that Roth benefit was one. It was there, and I was like, oh, I know this. Thank goodness.
So, did they ask the question regarding the 59 and a half?
It wasn't 59 and a half, but yeah, no, it wasn't.
There wasn't one.
Mm-mm. It had something to do about tax, um, had something to do with the taxes. So it could have been the contributions on it, whether, or, you know, I don't know. But do know this. On a traditional plan, all of your contributions, so know this, and Tanya talked about it, so this is not new. All of your tax deductible, your contributions are tax deductible. All of the contributions are tax deductible. And so that helps you on your income. So if you made $120,000, but you put $20,000 in a traditional, which is more than just using that for figurative numbers, then it reduces the amount you have to actually pay taxes on. So that's, go ahead.
You said all contributions are not taxable on a
On a
tradition?
traditional, all your contributions are tax deductible, is what I said. Tax deductible means you don't have to pay the taxes on that income right now, but you're gonna have to pay it later.
Okay.
So it's just tax deductible on your taxes right now. That's all it is. In order to take money out of your traditional IRA without any tax penalties, and I said tax penalties, I didn't say taxes, I said tax penalties, you have to be at least 59 and a half in order to take it out without any tax penalties. Once you take the money out, it becomes free to become taxed. The difference in that in a Roth IRA is a Roth IRA is only going to give you your contributions are going to be after tax. So you're not going to be able to use any kind of deductibles or deductions. So it's after tax. It's with your money that's already been taxed. But all of your investments grow tax free. So for somebody like me, at my age, if I decided to put more money in an IRA, I would need to do it in a Roth, because what I would be more interested in is not having to pay taxes whenever I decide to take this money out, because I don't have that long to accumulate my money. And I really think that that's all you need to know about that, unless you want to know more. Baruch, are you okay with that?
I think just understanding what is pre-taxed, which is your traditional, and then what is after tax, which is your Roth.
With it, you're wrong. That's exactly right.
Yeah.
But so how about some business insurance? Because I know that that's going to be on there. What is let's see. That's not the page I had it on. Hold on. Because there were 3. What if I was a person and needed to so what if I were in a partnership, Felicia, and I had insurance on me just in case I died, and I died, so now my wife takes over everything, but this insurance is going to pay so that my partner can own the whole company. My wife gets the money, my partner gets the whole company. What kind of insurance is that?
Ask that question again.
Okay, ready? So the question is, I'm in partnership. It's 2 of us, me and a partner. And I passed away, but my husband is now going to be, is going to get everything. So instead of my husband owning the business, because he don't care nothing about it, the insurance is going to pay him. So he's going to get the money so that my partner can get the whole business. What is that called? What kind of insurance is that? Ten, 9, 8. No? Just tell me what you think you know. Did we lose Baruch?
I remember it, but then I don't remember it.
So what is the name of one of the business insurance policies? There are 3 of them. Okay. All right. Well, how would then if and I said this yesterday, if Facebook's owner became disabled or something happened to him and I'd have to replace him, what insurance would pay for the hiring and the training of the new employees?
Um, I got lost.
Business insurance. No, that's not it, Pam. Oh, wait, no, that's not it. It's the actual name.
And you went to property and casualty.
Is that what that is?
Yes.
I have no idea what that was. So then what would happen then if I became disabled and I couldn't work? I'm the owner, but I'm going to get insurance so that if that did happen to me, my rent, my utilities, and my employees would be paid. What is that insurance?
Isn't that no, is it?
So, all right. So let me just say this. I just did all 3. So now I'm going to say this. If I were this person and I needed to pass if I were this, if I were this partner and I needed to buy the insurance so that if I passed away, my partner would take 100% of the whole business, is that considered business overhead expense, person income insurance, or buy sell? Which one is it?
That is buy sell.
That's buy sell. Tell me why you think it's buy sell.
Because business overhead is where it would pay for your utilities, rent, that type of thing. What was the other choice?
Key person insurance.
Key person is the key person is the first one you talked about with the with having to pay for trainers or to retrain new hires.
Yep, hiring and training.
And I got that written down. I don't know
Uh,
I said I got that written down, but I don't know what I put it under.
I know, but you don't want to have it written down. You want to just look up. I'm telling you, look away from your paper and think about what's being said. Business insurance, because you're not gonna have your paper with you when you go to your test. That's what I'm saying. Look away. So business insurance, there are 3 different types of business insurance. And so if you see buy sell, key person, or business overhead, would you know what those were?
Yes. In my notes, I don't have it as business insurance. I just have it under key person insurance, and that's why I didn't get it. That's
Yeah,
why
so
I didn't
it's
connect it.
business. Yeah, because you have to be a small bit. Nobody, a personal person wouldn't want it. Only a small business owner would want these.
Okay.
Pam, does that make sense? Okay, I'm just a Sherry. I'm just a Sherry. I just have gray hair. I'm really not that old. And y'all have to forgive me because I went walking this morning, so y'all see my roughness. I'm just rough. I've just been walking. I walked 3.5 miles. I'm so excited.
Congratulations.
Yay. Okay, so I do have another question around that same thing, Alicia and Pam. For that, when my business overhead expense that you talked about that pays the rent and utilities and pay my employees, I also need to get paid as a business owner. Is that going to be feasible? Is that going to be done?
No, it's not going to pay you.
Not going to pay me? Darn. Why not? Okay, and then, all right. Tanya, you want me to keep going? Where you want me to stop? Because I'll stop at that C word. So long-term care, Tanya talked about that being a few different. So in long-term care, there is respite care, adult care, home health care, custodial care, immediate care, and skilled care. What is significant about a couple of those different cares?
2 of them require a nurse.
With how many of them?
2 skilled
2
care
of them.
and what is it, immediate care, those require a nurse. You can have a nurse on some of the other ones, but it's not a requirement.
All right. Yes,
Like
ma'am.
home health care, a nurse comes to your house, but doesn't necessarily have to be a nurse. Yeah.
Yay. Very good. That's right. So the others are non-medical.
Respite care is for the family members that may be taking care of someone that's like terminally ill. It's so that they could get away for like a couple of days and like
Wait for the weekend. That's
revive
right.
themselves.
I found out a year ago that if you're taking care of somebody at home terminally ill, you could actually take them to hospice and they could keep them for a week or a weekend for you
Yeah,
without You
My
being a
cousin did that with my uncle when he got really ill. She came down and she lives in Atlanta. She came down, she was taking care of him, and I think she was here like 2 weeks. And because he was on hospice, they stepped in and took him for a week, and it gave her a chance to rest up and, come back and deal with everything else that had to be dealt with.
Yep, that's right. That's right. All right. So this is just going to be another asking you the same question again. Tell me about contributory and non-contributory.
Contributory.
Contributory. Oh,
Okay, go ahead.
Go ahead.
contributory is 75%, and that's when you are contributing, and so is the insurer contributing. And then non-contributory is 100%, and that's just with the employer only. I meant, right?
Yeah, absolutely. That's right. That's how that goes. That's how that goes. Thank you. Thank you. And then I have a question. So I just left my job. Yay. And found out that I am going to have to take my insurance. I could take my insurance with me. What is that called?
Cobra.
What?
Cobra.
And why is it called Cobra? It is called Cobra because it's high and it is going to bite me out of all my money. It's high. But when I leave my job, when I'm terminated from my job, how long do I have to determine to get Cobra?
If you want it, it's 60 days.
Baruch, do you agree with that? Pam, do you agree with that? Is it truly 60 days if I want it? I'm just asking a question.
Yep.
They went away. They're not even here to help you. But you're absolutely right. It is 60 days.
You're right.
It is 60 days. And so how long will I be able to keep that coverage? For indefinite?
No.
How long?
3 years, 36 months.
How long will I be able to keep the coverage?
You keep it, what is it, 2 years? A year.
I don't know. Baruch, Pam, where y'all at on this? How long can I keep that Cobra coverage after I've been gone?
How long?
Who said that? What?
Nobody.
Oh.
Nobody did anything. Nobody wrote anything. Maybe they tied up. Cobra,
It's not 2 years.
not 2 years, less than 2
18
years.
months.
How many?
18, a year and a half.
18 months. 18 months.
And if you pass away, then your dependent could keep it for the 3 years.
For 36 months, correct. That's correct.
I got to get them numbers right.
Yep. Well, 60, 18, and 36. 60 days, 18 months, and then double that is 36. Yep. I'm getting ready to trick you again.
Okay.
What is, if I said principal sum or capital sum, what does that mean?
Principal sum, capital sum, that is the two options for accidental death and dismemberment.
Thank you.
Capital sum would be if you missing one and then like a part of it, and then principal sum would be like if you're missing like your whole arm.
Look at y'all. There you
So
go.
capital would pay like a percentage. Is that what I mean?
Well, Principal,
Okay.
if you're missing
More
two,
than, more than
And then
one.
principal would pay the full face amount.
right?
Right. So capital is if you're missing one or lose more, one, and it's a percentage. And
Right.
principal is two or more, and it pays 100%.
That's correct. That is correct. Yep. And then, on the provisions, there is a term that would be used if I lost my insurance and I wanted to get it back.
Reinstatement.
It's a reinstatement. So how long do I have to reinstate it?
3 years from the time of it lapsing.
This is the provision.
Oh, yeah, for the reinstatement, isn't it 3 years?
Okay, so this is not life insurance. This is health now.
Oh, 30 days.
I'm sorry, this is health. Yeah, no, it's not 30 days.
Okay, that one I'm not sure. Yeah. 45 days.
45 days. 45 days. And so if you hear, if you see the word incontestability, then what does that mean?
Hey, one more time. I'm sorry.
The word incontestability. Incontestability.
Uh-huh.
What does that mean?
2 years.
2 years for what?
To deny any claims.
That's right. They can't deny them after 2 years.
But what's the difference on a health policy?
Is it one?
Yep, there's a difference on health. Okay, there's a difference in health.
Yep.
Because if they find out that you've lied, they can contest, and it doesn't matter.
There's no limit. That's right.
No limits.
Okay.
Okay, so on health, remember, just think about the people that walk around with a disability and they always hiding from somebody because they don't want nobody to know that they can actually work if they're claiming disability. Because if they find out, then they'll stop paying.
Yeah.
They lose their disability, they lose everything, that they're receiving. So, okay. Keep going. All right, 10 more minutes.
Okay. Then I just want to know if everybody still knows. There's something I want to know. There's something I wanted to know about if I see, because you don't know where I am, but if I, on a life insurance policy, if I was the first person to die, what is that considered? If the benefits get paid on the first death, what is that considered? What kind of life?
Jerry went over that.
Um,
And I'm only going over this like this just for memory purpose, so you can remember how to look at it. So there are two different types. Let me just say that. One will pay at the death of the first life, and the other will pay if both people, if at the second death. One pays at the first death, one pays at the second death. What are they called? So which one are you referring to, Pam? That's almost right, but which one are you referring to? The second one? The second one is survivorship. I'm going to give you that because you said survive. It's definitely survivorship life. That's the second one. So what happens with the first? When the first person dies only? If it's the first person, that means that the policy has to be something. Can't be a single policy.
It's
Joint. She said joint, shorthand typing. That's right. It's joint life. So, Felicia, remember that. Joint life, what does that mean?
two or more policies.
Nope. Joint life. What does that mean? When we're talking about it paying for somebody. If it's joint life, who is it? When does it pay? If who does?
After the joint life pays after the second.
So if it pays after the second, then what does survivorship life pay?
After the first.
So you got it backwards.
Okay.
So
Joint pays after the first.
joint pays after the first. Remember, joint has two people on it, at least two people on it. It's going to pay after the first. Survivorship pays after both people, after the second person. So basically, both people, if it's a joint policy, have died. It's a joint policy, and after both of them, when the second person dies, then the survivor of all of that gets the money.
Okay.
Okay?
Yeah.
The survivor gets the money. And Felicia, for your benefit, this is for your benefit. Tell me about lack.
Did she just laugh?
She laughed out loud. This
Okay.
is your benefit.
Legal agreement, consideration, and
Yeah, you're doing it. You're doing it. Look, she did just like that, Tanya. You didn't see that. She pointed. She did just like that.
You got this.
and
Come
this
on.
is what I always get right.
Exactly.
Legal agreement, consideration, and competent.
And competence. Can't be drunk and can't have mental issues. Consideration, Felicia. Consideration connects with what?
Money.
Money. Show me the money. It's all about the value, the policy, the value, right? Absolutely. See, look at there. When you do it a couple different times,
Yeah.
then it just comes back easier, right?
Yes.
Yeah. How long is that grace period?
For
a how long is the grace period for a premium on a life insurance policy?
30 days or 31 days, a month.
30 to 31 days, absolutely. And on the entire contract, which Baruch answered this before, but I want you to answer it. What are the two components of the entire contract?
The application and the policy.
Absolutely. And so on the entire contract, there's an insuring clause, and that tells you what?
Pretty much the basic information about the insurance policy.
Yep, that's your summary. Basically,
General information.
I call it the deck page. That's what I call it. But it's going to be it's the insurance clause, who pays, the amount, all that stuff. Okay. All right. Tanya, I'm just you tell me to stop.
That's it. That's good. I mean, you went over 80% of what's going to be on the test. So right now, basically, Felicia has both life and health in her head, and she sounds pretty good. So she should be ready to blow this away.
That's right.
All
When
right.
when you put the box together, Felicia, remember, have your notes on one side and a box on the other side.
Yes, ma'am.
Look at absolute assignment, collateral assignment, know what both of those are, then go pack a box. Say it out in your head what absolute and collateral assignment are, and then go back and look at your notes after that box is finished.
Yes, ma'am.
So, everyone, when you go to your test and you sit down in the room, they give you a piece of paper or a erasable board or something to write on.
Erasable board.
Everything that you remember, just start writing. Just start writing. Just write. The test doesn't start till you press the button to start.
Mhm.
If you need to sit there 10 minutes and write stuff down that you remember, that you want to be able to recall,
Yep.
write it. And you don't have enough paper, hold your hand up.
Yeah, bring you some.
They'll bring you something else. Okay? And just go to writing. Now, once you start your exam, they usually, because it's all on the computer, go through the instructions. Go through the instructions. Just sit there, look at the instructions. They'll tell you about if you want to skip and what to do and so forth. Look at every single bit of it. Breathe.
Mm-hmm.
Relax. You got your notes. You've written everything down that you think that you need to remember. And open it up. It is okay if the first 10 questions don't look like nothing you can answer.
Right.
Just click on it, skip, click, skip, click, skip, click, skip, till you see something. Oh, I know this. Then answer. And if you have to skip 2 or 3 more, it's going to start coming to you. Just read the answer choices first. Then read the question. Look at your answer choices and answer, because you got to make sure that those questions don't have not or except in them. And just go through it. It's just breathe. Watch your time a little bit, because you don't want to spend so much time that you do not have time to answer the state portion of your exam. Sherry, how much time did you take?
So I took right at 2 hours, which scares me because I was just going through them. I didn't even take the whole 2 whole hours. But the one thing that I will tell you that matters to me most, I get freaked out with time. So at the very top right corner, you can hide your time because it shows you, it has a clock on the top that tells you how much time you got left. So I clicked on it so it went away. I had to hide it because if not, I panic on it. So once I got through like 30 questions, I went and looked at my time, and then I was like, "Oh, I'm good." And then I just kept going that way because I typically go too fast sometimes.
Make sure that you do not change your answers unless you are 100% unless you're 100% sure that that answer that you have, your new answer is correct.
Right.
Stay with your gut. If you're taking your test early in the morning, eat so you're not starving in there and thinking about your stomach.
Yeah.
They do not want you moving, so they don't want you going to the bathroom and all that. Go to the bathroom before you sit down, whatever. But take your time, go through it, watch your time. You have a 2-part exam. 2 parts. You want to make sure that you have enough time to answer the questions on the other end, which is your state.
When I was done with the first part, I thought I was done. I literally did. I was like, oh, I got a lot of time left. Click, and I was like, oh no. Yeah.
The 2-part exam. State comes next. All right, then go through your state. You cannot go back to the first one. So be finished.
It tells you, yeah.
All right. So Friday's your day. Put in just a little time today and a little time tomorrow. The day before the exam, you just need to look at your state and look at that sheet that has all the dates and times.
Okay.
Yeah.
Brooke, schedule your exam for this week. You and Keisha get in there. I think Keisha's on Friday, the 17th. Pam, make sure that you go through the state on the online program. That's going to be very, very important to go through that state because there's going to be a couple of things that's different. Study it. The only terms I want you guys to really kind of memorize are the unfair trade practices. There's 8 of them. Know the unfair trade practices. Okay. Know the unfair trade practices. Other than that, just know the concepts of everything. And we've gone through the concepts. Sherry has taken you back through everything as simplified as you can. A way to remember it. So we thank you so much. We hope this was helpful. Also, just to let you guys know that we've gone live on YouTube this entire time. So it's going to be recorded and over there. We are broadcasting live inside of our Facebook group. It's only going to be there till today, and I'm going to take the link out. So if anybody wants to see it, it will be on YouTube. So other than that, I think we've given a lot of value today. Sherry, I thank you for what you're doing. And yes, we're going to bring you in to do a whole lot more of these. What she said, thank you.
You're welcome.
This was powerful.
Oh, this is
I
beneficial.
wonder. Yes. Valuable, powerful, really helping people pass the insurance exam. And that's all we've been trying to do. And you know, this is it. So we want you all to come back victorious. Please let us know. Pam, let us know when you schedule your exam. And you know, when you pass, post it. Anything else you want to give them, Sherry? I'm gonna let you have the last words.
Oh, that's it. Listen, just again, just kind of go through some of those things that we just talked about and do what I just did. Go through it and then go back and pick up one other thing that if it wasn't 100% clear, just say, you know what, I'm gonna come back to that. And just keep going and then come back to it. And then keep going again and then come back to it again. Because repetition is really what does it. And I will absolutely say this. Baruch's 5 steps saved my life. I literally did it. And I can say I did that. I did not read a question first. I went straight to the answers. And when I read the answers, I said, oh, this one is different. So I know that's not going to be a part. I almost really knew what it was, but I didn't, decide what it was until I went back and read the question. And so that process of elimination literally worked. So again, thank you, Baruch. If you can hear me, I told your mom to tell you thank you because it absolutely helped. And it made me feel much more confident, especially where I wasn't quite sure about what the answer would be. Once I really read those answers and said, I don't know what this is, then I read the question and then I went back and did a process of elimination and I was like, okay, so it's going to have to be this. So that absolutely helped. So please use that which he talked about on one of our earlier sessions. Yay. And forgive me again, y'all, because I've just been exercising. I feel hard. I feel